Hola guys, I hope you are all doing very well and I hope you are quite busy in preparing for your upcoming November 24 examination. I thought I'll make a small video on the entire concept revision of India's 103 business combinations, which you know obviously is very important, exclusively important for this upcoming November 24 examination. So on that note, we'll straight away start with the concept of business combination. See, the term business combination actually means there is one entity which is obtaining the control over the business of another entity. If one entity obtains control over business of another entity, this event or transaction is called as business combination. In this, there are two aspects again. One, what is the meaning of the term control, and then how to understand what is a business. Obtaining control over business is a business combination transaction, right? Now, what is obtaining control? What's the meaning of the word control and what is the meaning of the word business? Now, the term control has got the same meaning as it is understood in Ind AS 110. That is in consolidation chapter, whatever meaning of control is there, which broadly sums up to decision making power. Okay, the decision making power on the relevant activities. Relevant activities are which are most significantly impacting your returns from the entity. So that important decision making power if you have, that is called as you are having control in a very simplistic way. Now coming to the term business, the word business is defined under this standard only, which is Ind AS 103, which we will see as we go further. But just for understanding purpose, let's see like this. A Limited is one entity, B Limited is another entity. A Limited absorbed B Limited. A Limited absorbed B Limited. So in future, you will only have A Limited. So assuming that B Limited is satisfying the definition of business, this absorption is a business combination to one example. This is BC example number 1. Example number 2. X Limited is one existing entity. Y Limited is another existing entity. X Limited purchased 80% shares in Y Limited. Normally, so because of this 80% shares, there is a parent subsidiary relationship that gets established, and therefore we all know that we have to do consolidated financial statement. But because you purchased 80% shares in Y Limited, this control acquisition is happening here because more than 50% voting rates are there with X Limited. So generally, in the absence of any other information, we presume that X Limited is having control over Y Limited. In this case, X and Y continue to exist independently as two separate legal entities, but X Limited has got all the decision-making power on Y Limited. So hence, this event of parent subsidiary relationship getting established, even this is also a business combination transaction. Of course, this fellow is called as parent. This entity is called as subsidiary. And of course, they'll prepare consolidated financial statements in accordance with Ind AS 110. All that is fine. But prima facie, this is a business combination transaction. Next. There is P Limited. There is Q Limited. This Q Limited is having multiple businesses. Business 1, business 2, business 3. Now, P Limited has taken over not all the entire Q Limited, but one business they have taken over. So, the second business of Q Limited, that alone they are taking over. If that unit alone is constituting the definition of business according to Ind AS 103, then P Limited has done a business combination transaction. That means, from these three examples, what you must understand is, the other entity need not be liquidated. For example, if you see our AS 14, what we studied in CA Inter, in that the selling company always used to get liquidated. That is okay. Here also B Limited got liquidated. It's still a business combination transaction. But in the second example, I acquired control over Y Limited, but Y Limited is not liquidated. Nevertheless, it is still a business combination transaction. The last case, I did not even acquire control on entire entity Q Limited. What I have acquired control is a business unit of Q Limited. As far as that unit is constituting the definition of business, this is a business combination transaction from P Limited point of view. Clear, sir? So, the scope of business combination in Ind AS 103 is very, very high compared to accounting standard 14. And now we'll see what is the meaning of business, plain business. Now, the definition of business is like this. It is an integrated set of activities and assets that are capable of being conducted and managed for the purpose of providing goods and services to the customer, generating investment income or any other operating income. So, he's saying that there should be an integrated set of activities and assets. First thing. And these should be capable of being conducted and managed. That means on these assets plus activities plus management should be giving rise to goods and services, investment income, or any other operating income. This, if you again revisit or reframe it, there are three elements in this definition, sir. One is inputs, the other one is processes, the other one is output. Inputs mean any resources like your intangible assets, non-current assets, property, plant and equipment, all these non-current assets, the organized skilled workforce, the employees what you have, all these are called as inputs in your business. On this inputs, if we apply some processes again means an activity, a procedure, a protocol, the way of doing things, the management activity. For example, in a manufacturing organization, the production activity is there. Then there is a management activity. Then there is a marketing and sales function. There is a finance department. These all put together will help to run the business, isn't it? So all this chain of activities are called as processes. So you should have assets. You should have organized skill force. On that, when processes are applied, these activities and plus these assets put together should be capable of generating output. Now, what is output here? Output can be the goods or services what you give in the ordinary course of business, or if you are planning investments in various entities, the investment income that is getting generated out of that, or any other operating revenues are also okay. So when you say output, it's not just goods and services, it can be any other kind of operating income also. Now here, from the definition, you observe integrated set of activities and assets that are capable of conducted and managed in such a way that some output is generated. That means, is output mandatory? Is output compulsory? Output is not mandatory. The capability of generating output is to be there, but as such, generating output is not a mandatory criteria to qualify the definition of business. Then what is mandatory? Obviously, there should be inputs and there should be processes. Processes means the way in which you do the business, the activities, the management function, the production function, the distribution function, the sales function, whatever are important core activities, they are all considered as processes. So generating output is not mandatory, but the capability or ability to generate output should be there. Now whatever we have acquired, is it satisfying the definition of business or not? For that, the standard has given some guidance. Now, if guidance is given in two steps. Step number one, you will do something called as a concentration test. Step number one is an optional test. This is not a mandatory test. Step number two is called as a detailed business assessment test. First, we will understand the detailed business assessment test and then we will come to concentration test. Now, in a detailed business assessment test, what he is asking is, in order to qualify a business, you should acquire input, that is sure. Plus, you should acquire processes. That processes, at least you should have one substantive process. So, any process is not sufficient for us. It should be a substantive process. The word substantive has got different meanings like material, important, considerable, impactful, depending on the context where you are using. So, substantive process means an important process should be taken over. Now, again, they are further explaining whether the processes I have taken, is it substantive or not substantive? How will we decide? For that, the guidance given in the standard is like this. If the setup what you have acquired, if it is already not generating output, then what you must ensure is that processes whatever you have taken, they must be critical to generate output. Today output is not there, but if the processes what you have taken over are not taken over, then creating output is impossible. So that kind of process is what you should be taking over. Not only that, you would have taken over inputs, the assets and all. Along with that, organized workforce are also required. That means employees with skill, knowledge and experience are required. So 2 points we are asking, sir. One, the process what you acquire must be critical to generate output. That's a very core important process. Plus, the inputs should include organized workforce with necessary skill, knowledge and experience. If these 2 points are satisfied, I do not care whether even if there is no output also, whatever you have acquired is qualified as a business. Now that it is qualified as a business, whatever I have acquired is now becoming a business combination transaction. Hereafter, the standard will continue to apply. So that's how you must understand first case. Second case, what if there is an output? That means you have acquired something and that setup is already generating some goods or services. In that case, whether what I have acquired, is it a business or not, how to test. Now here, since already output is getting generated, I have a little sense of comfort inside that most likely whatever I am taking over is likely to be a business. Therefore, the standard has given you two options. Means there are two ways of passing this test now. Now, before we read that, if you observe here, one is it should be a critical process. Next, your input should include organized workforce. Correct? Now, these 2 points combined you should satisfy here also. The process should be critical. The inputs should include organized workforce. So whatever points are there in the left side, right side, also same points are there. When output is not there, whatever you have to satisfy. When output is there, also you have to satisfy the same thing. Sir, I am taking over processes, sir, but workforce I am not taking over. What is the answer? If you are taking over processes, which is critical process, and you are saying that organized workforce you are not taking over, in this scenario, it is not a business. Now coming to this case, because there is an output, the standard says that if you are taking over important process and you say that I don't want to take over organized workforce, the standard says okay, but because you are already generating output, I'll give you exemption here. But the process what you are acquiring should be unique or scarce. That means it is such a secret ingredient or secret kind of process you are taking over, for which the process itself is the critical or the most unique process. For that, organized skilled workforce is not necessary. You can manage this with your own employees also. That means the entire business, the output generating capability is purely based on the process rather than the skill of the employee. So if the process is that kind of unique or a scarce process, in that case, even if you do not take over the organized workforce of the other entity, I can still qualify you as a business. That means input is mandatory, sir. Process should be a substantive process. Whether the process is substantive or not, how will I know? That depends on whether you are already generating output or you are not generating output. If you are not generating output, then what I will check is the process should be a critical process and you should be taking over organized workforce of the other entity. 2 points. But if you say that I am already generating output, then these two conditions again you can pass. You can say that the process should be critical plus organized workforce is also taken out. These 2 points satisfied, you are a business. If you say that I am not taking over the organized workforce of the other entity, then I'll ask you, is the process what you are taking over, is it a unique or scarce process, for which organized workforce of the employees or organized skilled employees and all are not required. The process itself is the most unique and the scarce thing which is capable of generating output. In that case, organized workforce, even if you do not bring, that is still fine with me. So this is how you do a detailed business assessment test. Now when you establish that this is the business, then only India's 103 ka further accounting will be applicable. Suppose you fail, you tell me that sir, asli inputs I am not taking over, or have taken over, I did not take over any process. Either you don't take over input or you don't take over processes at all. In that case, whatever you have acquired is not a business combination transaction. But in case you have a doubt, I'm not very confident whether I have acquired a business or whether I have acquired merely a group of assets and all. Then instead of troubling yourself with step number 2, which is detailed business assessment test, you can also do a simple step called as concentration test, which is our step number 1. Now the concentration test, how it works is, I'll apply the concentration test. If the concentration test is passed, we'll say that you have not acquired a business. This is a pure asset acquisition. No sir, concentration test failed. If the concentration test is failed, in that case, I cannot conclude that you are a business. In that case, you have to go and again check whether the process what you have acquired is a substantive process or not. Step number 2 will follow. So this chart, as you can see, if the concentration test is passed, then there is no business, it is an asset acquisition. If concentration test is failed, then you have to apply step number 2 for further evaluation. Now the question is how to apply concentration test. Let's do one thing. Before we go through the steps given in the standard, we'll roughly try to understand what exactly concentration test is trying to target. So for example, A Limited purchased, A Limited already holds, or else let me put like this. A Limited purchased or A Limited absorbed B Limited. The PC paid here is 100 rupees. For this PC, you will take over some assets and liabilities from B Limited. Now, in that assets, there are A1, A2, A3, A4. 4 assets are. Some processes and all are also there, but prima facie 4 assets are. Now, this A1 ka value is 10 rupees. A2 ka value is, okay, let's make it even more simpler. 2 rupees, 3 rupees. This is 1 rupee, or else this is also 2 rupees. So that's how much? 5, 7. This is 10 rupees. Now, you paid 100 rupees and you acquired 4 assets. Maybe process also you might have acquired some processes, but you observe closely. The entire PC what you are paying is predominantly concentrated into a single asset, which is A. So A4 ka fair value is 90. The PC what you are offering is 100. That means the predominantly the PC what you are paying is concentrated into a single asset or a group of similar assets. Therefore, you predominantly purchase the single asset and not a business acquisition. So what we are trying to check is whether the PC what I am paying, is it concentrated into a single asset or a group of similar assets. If that is the case, in that scenario, we will say that you have passed concentration test because my entire money is going into a single asset or a similar group of or a group of similar assets. Therefore, what I have acquired is an asset acquisition and not a business acquisition. So, how the standard has framed this? Now look at this example. X Limited holds 10% in Y Limited. X Limited already has 10% in Y Limited. Now, X Limited further acquires 70% in Y Limited. With 10% in Y Limited, I am not having control over Y Limited, but another 70% in Y Limited I bought, now I am having control. So total I am having 80% share. Now, this is a business acquisition or asset acquisition that I want to know. So for that, look at the standard guidance. Just imagine this is balance sheet of Y Limited. We are not bothered with the numbers and all. Just so there is share capital, there is other equity, then there are liability, then there are so many assets here. Okay, so now what our standard says is take the PC paid at fair value. So work out the fair value of the 70% consideration what you are giving. 70% acquisition, whatever consideration you are paying right there. Existing investment, you are already having 10%. Existing investment 10% fair value also you bring. Everything at fair value. So 70 plus 10, 80%. Then a company another 20% you are not holding, but somebody else is holding, that we are calling it as non-controlling interest from consolidation chapter. This also you take it at fair value. So what you have done effectively 70 plus 10 plus 20, total 100% shares of the Y Limited value you have gotten. To that add the fair value of liabilities. Whatever liabilities are there, balance sheet of Y Limited, get the fair value. So guys, by doing this calculation, what I am trying to do is, these three put together is giving the fair value of these two, share capital plus other equity. Liabilities here I am adding. So this entire number, whatever I am having here, this is virtually representing the fair value of entire equity and liability side, which also should be the fair value of asset side. So what we do is, from this we remove cash and bank balance. So now can I say that this represents fair value of gross assets other than cash? So let us say this amount is coming to 1100. So we are taking the same number as I say study mat example. This is just step number 1. Step number 2. Now what you will do is take these assets, one by one go and see what are there in this A1, A2, A3, A4, A5. There are different groups. Suppose the values are like this. This is 1050, this is 5 rupees, this is 10 rupees, this is 20 rupees, this is 8 rupees. Now you observe, sir, your overall consideration plus other like other shares plus liabilities all put together. Overall, it is 1100. In that, majority of the amount is concentrated only on a single asset called as A1. So even though you are paying 1100 PC overall, in that effectively you are trying to buy a single asset called as A1. The entire liability and equity side of Y Limited is concentrated and focused only into a single asset called as A1. Now, how can I say that if that level of concentration is there? How can I say that this is a business acquisition? Predominantly you are acquiring a single asset called as A1. So, sir, how will you know whether 1100 and 1050 whether it is substantially concentrated or not? How will we know? We do not know, sir. This is a judgment based analysis. According to your ICS study material example, they are considering that a percentage more than 90% is considered substantial. As such, there is no proper definition given there. It's a fact of case to case based analysis. Suppose instead of the numbers being like this, if the numbers are like this: 300, 450, 180, 250, 200, something like this. So I cannot, if A1, A2, A3, A4, A5 are different kind of assets, then I cannot say that 1100 rupees is concentrated into a single asset. They are spread across various assets, and therefore we have failed concentration test. Now that I have failed concentration test, there is a chance that I can be a business. Therefore, I have to apply step number 2 and see whether the processes are substantive processes or not. So this is how we evaluate whether what we have acquired is a business or not. I hope I am clear to you. So why are we bothered whether it's a business acquisition or not is, see sir, if it is, suppose the PC, you all know from your C enter, PC paid is 100. The fair value of net assets acquired is 90. You paid extra PC of 10. This 10 rupees we are calling it as goodwill. Or if you pay less, it's a bargain purchase, then we'll transfer it to capital reserve. This is what we have already in mind. You can create goodwill only if whatever you have acquired is a business. If what you acquired is not a business, you cannot create goodwill or capital reserve. So, in order to do this entire accounting and all, prima facie it's important that what you have acquired should be a business. If it's an asset acquisition and not a business acquisition, then this kind of goodwill creation is not permitted by IND AS 103. So that's the reason we have to go through all this process. Next, coming to business combination accounting. Suppose, sir, you have established that whatever you have taken over is a business. If whatever you have taken over is established as a business, then according to this standard, you have to apply a method called as acquisition method. You have to do a method called as acquisition method. Now, what is there under this acquisition method? Sir, in the standard, in the order if you go, there is a particular way of learning. We'll try to stick to that way as much as possible, but here and there I may deviate to make the things a little bit more easier for you. Anyway, first thing. First, you have to identify who is an acquirer. Acquirer means what? See, there are two parties now. One entity is acquiring control over the business of another entity. The entity which is obtaining control is called as acquirer. The entity on whose business control is obtained, that other entity, the selling company, is called as acquiring. So the purchaser, no, in general parlance, the purchasing company is called as acquirer entity, selling company is called as acquiree entity. Now, this acquirer is a fellow who is obtaining control over the other party. So this acquirer in his books, for accounting this business combination transaction, he has to apply the acquisition method, what we just now discussed. Now, for that, obviously, I have to identify who is acquirer. For that, the standard says a simple definition. What it says, whoever is obtaining control over the business of another entity, that fellow is the acquirer. Now, in a given question, how will I identify who is acquirer, who is acquiree? Most of the cases, it is pretty straightforward. So, it is like this. If PC is paid in the form of cash, the entity whichever is paying cash, that entity is the acquirer. The entity receiving PC is the acquiree. If PC is paid in the form of shares, the entity which is issuing shares is the acquirer. The entity which is receiving the shares is the acquiree. So generally this is how it works, unless it is a reverse acquisition. In a reverse acquisition, just to simply explain what is reverse acquisition, suppose there is A Limited. In A Limited there are 200 shares. Share capital is 200 shares. Now A Limited now absorbed B Limited. As a result, PC also it has to issue. That PC, they have issued 300 shares. Since PC issued 300 shares, the total number of shares now in A Limited will be 500 shares. In this 500 shares, 200 shares are held by the existing shareholders of A Limited whereas 300 shares are held by the new shareholders who are now joining A Limited, who are earlier shareholders in B Limited. Now, if you technically observe, legally A is absorbing B, A is issuing PC, B is receiving share. So, ideally, according to the general definition, the person who is issuing PC should become the acquirer. Normal. But if you observe, if you look at the shareholding pattern, my existing shareholders are now reduced to a 40% shareholding, whereas my new shareholders are having 60% shareholding. And these people to whom we have given these 300 shares, these people were earlier anyway controlling B Limited. So now they are also controlling A Limited by virtue of their majority shareholding in A Limited. Now, even though legally it looks like A Limited acquires control on B Limited, but looking at the shareholding pattern and all, you understand that the shareholders of B Limited are actually controlling A Limited. Therefore, this is called as a reverse acquisition. In a reverse acquisition transaction, the entity which is receiving the shares, that is here in this case B Limited, this fellow is the acquirer and A Limited becomes the acquirer. So legally who is acquirer? A Limited is acquirer, but in substance for accounting purposes B Limited is the acquirer. So who is acquirer, who is acquirer? Prima facie rule is control. Most of the cases it will work like whoever is paying PC, that fellow is the acquirer, who is receiving PC, that fellow is the acquiring. But in a reverse acquisition case, which is possible only when shares are issued like this and all, you should be really careful, watch the shareholding pattern and all, then decide who is the acquirer, who is the acquiring. Second thing, identifying the acquisition date. Acquisition date is the date on which acquirer obtains control over acquiree. Now, why is this date important? You all know PC versus fair value of net assets. You compare, you identify whether the difference is a goodwill or a bargain purchase gain, hence transfer to capital gain. So PC, on which date will you measure? Net assets ka fair value, on which date will you compute? So on which date you will compare them and identify the goodwill? So that date is called as acquisition date here. That acquisition date, how to identify that acquisition date is the date on which acquirer obtains control over acquiring. Now, generally, sir, obtaining control means what? Obtaining control means what, sir? Simply put, decision making power. So when the decision making power changes hands from acquiree to acquirer, that date is called as the acquisition date. Now, general rule is, when assets and liabilities are transferred and PC is paid, this date, which we also call it as the closing date, this is the date on which control is transferred to the acquirer. So this only will become the acquisition date. So normally majority of the cases, closing date, the date on which PC is settled, the date on which assets and liabilities are taken over, that date, closing date, is the date on which acquirer obtained control over acquiree. However, this is a general rule, but the acquirer and acquiree may agree any other date also. It is a matter of agreement. Sir, from which date onwards X Limited should start taking decisions in Y Limited? That is a matter of agreement between X and Y, no? So if they have agreed any date, that date only will become the acquisition date. Otherwise, if the question does not say anything, in that case, or the agreement does not say anything, then the closing date must be identified as the acquisition date. So very simple. Now sometimes, let me take an example. A Limited, B Limited, both are engaged in pharmaceutical industry, pharma business, they are manufacturing medicine. There is a particular medicine which is manufactured by A Limited also. The same medicine is also manufactured by B Limited, nobody else in the country. So only A and B are manufacturing a particular kind of drug. Now, A Limited wants to take over B Limited. If A wants to take over B Limited, now together there will be a single entity. That means in the entire India, there is only one entity which is having license to manufacture a particular medicine. That will create a monopoly situation. So, if this merger has to go forward, Competition Commission of India ka approval is required. Now, A and B have negotiated everything, they have valued everything, PC and all is that, everything is fine. So, but Competition Commission of India ka approval is also required. So, this kind of approvals are called as regulatory authority approval. If any statutory or any regulatory authority approval is there, then what you have to check is this approval, is it substantive or not substantive? Sir, what is substantive, not substantive here? Substantive means it is critical, and whether you will get or not is there is an element of uncertainty. So it's a very highly impactful kind of thing as we go further. We do not know whether approval will come or not. That kind of. Not substantive means it's a procedural requirement. You just apply it anyway, you will get it. It's not a very serious kind of thing. So the failing chance is very, very less. So if it is an important critical kind of approval, which without which you cannot proceed further, that kind of things are called as substantive approvals. So whenever a regulator approval is required, all you have to check is whether that is a substantive approval or not. If you say that this is a substantive approval, then your acquisition date cannot be a date before the date of such approval. You people have agreed the PC and all, you have agreed on when to transfer the assets and liabilities, everything you have decided, valuations and all are done, fine. But CCA commission ka approval has not come. Until the date comes, your acquisition date cannot be identified. Sir, on the date on which I received the approval from Competition Commission of India, can I take that date as the approval date? If no information is given in the question, you can take that. Of course, after Competition Commission of India approval has obtained, you may finalize another date also. It all depends on facts and circumstances. So that's why we look at the language. The language is given like this. Acquisition date cannot be earlier than the date on which approval is obtained. Sir, what if the approval is not a substantive approval? If the approval is not a substantive approval, then whatever date you people have agreed, that date only is the date of acquisition, even though that regulatory approval has not actually been received, because that's anyway not substantive. So next step is recognizing assets, liabilities and all. But before we go into that, let me put a small framework for you, and then with that background we'll try to discuss. Sir, I am discussing all this with a background imagination that there are two entities. One entity is absorbing the another entity. It can be control acquisition also, where the other entity also is legally continuing, but just for simplicity, we are assuming this. Whenever required, we'll change into that example also later on. So when A absorbs B Limited, in C enter, what are the entries we used to write? We used to write business purchase account debit to liquidator or something like that. So here I'm simply calling it as PC payable, or the vendor, or if the entity B is liquidating, it's whatever. So this entry is passed with the amount of purchase consideration. After that, the next entry, everybody remembers, we incorporate the assets and liabilities. And you cancel the business purchase. So all these are recorded at fair value. So if net assets PC gap is there, that gap either we identify it as a goodwill, if there is a gain, bargain purchase gain, we ultimately transfer it to capital. So all these stories will come to us as we go further. I'm just kind of giving you a recap of what we learned in basic level. So PC payable liability, whatever you created in the very first entry, that you cancel, and you discharge PC in whatever mode you have agreed, cash, equity share capital, securities premium, whatever different modes you agree to pay. Now, as you all can apparently see, this business purchase account is getting cancelled here. The liability account also is getting cancelled here. So effectively you are writing an entry called as assets to liabilities to consideration paid. Entry will not tally goodwill or capital. So this is a broad entry. With this framework, if you start thinking, it's easy for you to understand this. Okay, now coming to the next one. Sir, when in a business combination transaction, when I incorporate assets and liabilities, the entry should be recorded at what amount? The general rule is all assets, all liabilities should be recorded only at fair value. Fair value. So fair value on which date? Fair value on the date of acquisition. That acquisition date, the fair value. So you have to record all the assets and all the liabilities. But here certain exceptions and special cases are there, where you will not be using fair value, you will be using some other value. So that and all we have to see. So some are fair value exceptions, some are recognition exceptions, where it apparently looks like I'm going against the principle of some of the standard, but that's okay in the context of business combination. So either in terms of recognition or in terms of measurement, there are certain exceptions. So instead of separating like that, I've called it as special cases. Let us see what are that. First one is intangible assets. See, the acquiring entity, the selling entity has some intangible assets. They have the intangible assets, but they did not recognize them in their balance sheet. Today in their balance sheet they are not appearing, but they are having intangibles. And in the course of business combination, I am acquiring those intangible assets also. So the question is, can the purchasing company, can the acquirer entity recognize intangible assets which are not recognized by the selling company or the acquiring entity? The standard says, even if the selling entity has not recognized certain assets because of the recognition criteria not satisfied, the purchasing company can still recognize the such assets at fair value provided recognition criteria is satisfied. So it does not matter whether the selling company has actually recognized such assets in their books or not. It's all about whether you satisfied the recognition criteria or not. In case you have satisfied the recognition criteria of intangible asset, then definitely you can recognize the intangible asset at fair value. It does not matter whether such assets are appearing in the books of selling company or not. You have taken over, control is obtained, future economic benefits are there, that is enough. You have passed the recognition criteria. Now coming to next one, it is in process research work of an acquiring. So look at this. So I am acquiring B Limited. So this B Limited is into some research work. Research is not yet totally completed. So it is a research work in progress. Some work is happening, so research work is happening. But if you look at the balance sheet of B Limited, you will not find any asset with the name of research WAP because entire research expenditure is transferred to P&L account in accordance with requirements of India's 38 intangible. Now, when A Limited absorbs B Limited, A Limited will definitely take over the research work in progress also. But research work in progress, even though it's not appearing in your balance sheet as an asset, that is not waste papers, no. They are all important information. They burnt lot of crores in that doing that research. So when somebody is asking you the results of your research and the existing status of your research WAP to be taken over, B Limited is not going to give it freely. B Limited will definitely ask consideration for that. So when A Limited pays PC to B Limited, A Limited paid PC not only for the assets, liabilities, processes, also they also paid money for this research WAP. Now the question is, when A Limited records A1, A2, A3 to L1 to business purchase, so many assets, so many liabilities I am recording. In this, can I also recognize research WAP as an asset or not? Sir, why this question even arises? The research expenses should be transferred to P&L account, so A Limited should not recognize. Let us see what will happen if we recognize and if we do not recognize. So A1 is recorded at a fair value of 300, for this a fair value of 200, for this fair value of 100, for this let's say fair value of 50. So 300 or 500, 600, 550. 550 is the net assets value. Now let us say the business, the PC part is 700 rupees. Research WAP has a fair value of let us say 80. Now for one moment assume that I do not recognize research WAP as an asset. So I simply recognize 3 assets and 1 liability. So who's so 550? For 550 piece I paid a consideration of 700. So your goodwill balancing figure will be 150 rupees. Okay. Now, if you recognize research WAP, then what will happen? If you recognize research WAP, then this will be 80, this will be 300, this will be 200, this will be 100, this will be 50, this will still be 700, but the balancing figure will be 30. Now, how our standard thinks is, if you recognize research WAP as an asset, then what will happen at the max? In the balance sheet, one intangible asset called as research WAP is created, which we will amortize it in future. But if you do not recognize research WAP at all, in that case, the amount what you paid for research WAP also is getting subsumed into goodwill. And once it becomes goodwill, bringing or eliminating that goodwill is very difficult, because for goodwill, as we know, we do not have any amortization for goodwill. You have to go and do impairment testing for goodwill in accordance with India's 36. So, once it becomes goodwill, it is difficult to remove it. I know research WAP actually does not qualify to become an asset considering the definition of asset. But if you don't recognize research WAP, it is anyway coming to the balance sheet with the name of goodwill. So rather we recognize it as a asset and ultimately we eliminate it in the form of amortization. So that's why the standard has given this as a exception. So even though as we all know research WAP does not qualify for recognition as an asset, you still can recognize it as an asset. This is one exception. Next, contingent liability case. See, when if you have to recognize a provision, P&L account debit to provision, if you have to write this entry for any general provision under the scope of India 37, there are three conditions. One is there should be a present obligation arising as a result of past event. So obligation should be there on. Next, probability of outflow of resources should be there, and then a reliable estimate could be made towards the amount of obligation. If all the three conditions are satisfied, pass, and then you can confidently write a provision. Out of these three, at least one condition you fail, then you cannot recognize above entry. You cannot recognize the provision. So that means, imagine you say that there is no present obligation. If there is no present obligation, it becomes a possible obligation. And all possible obligations prima facie are contingent liability. Similarly, you may say, sir, I have a present obligation, but the chance of outflow is very, very less. But I know the amount of obligation, but the chance of outflow is very, very less. Or these two passed, but you could not make a reliable estimate towards the amount of the obligation. In these cases, sir, you cannot recognize provision. So do not rather we will only disclose as contingent liability. So the scenarios where the provision recognition criteria fails, that automatically becomes a contingent liability disclosure. Now understand the case carefully. A limited is absorbing B limited. B limited balance sheet, some contingent liabilities are there. Who acquiree books lo contingent liabilities are there. The general rule is, if it is a contingent liability for you, since I am acquiring you, your contingent liability should become my contingent liability. General rule. But look at the exception here. If you are having a contingent liability which falls into this category, that means there is a present obligation arising as a result of past event. Reliable estimate, third condition also passed, but chance of outflow is not there. Therefore, you have disclosed it as a contingent liability. The standard says that this kind of contingent liability are to be recognized as actual liability. That means you can create a provision for this by acquiring. That means when you write this entry, the assets to liabilities to business purchase entry, whatever is there, the entry when you are writing, in that liabilities include that fellow contingent liability also. Not every contingent liability. There are contingent liability possible in three scenarios, sir. Only the second scenario where there is a present obligation, but it cannot be recognized as a provision because the chance of outflow, the probability of outflow is very less. In that case alone, their contingent liability will become your real liability. Rest all cases, their contingent liability will become your contingent liability. So that is one exception. Another exception is called as an indemnification asset. Now, A acquired B. On B, some legal cases are pending. Now A is absorbing B. Now, when we write assets to liabilities, incorporation entry of various assets and liabilities, in this liabilities, imagine A Limited, our company, acquired company has recognized a provision for damages. Because legal cases are pending, for that damages provision we have recognized. Let us say we have recognized it 100. Now, if B Limited ka owners, at the time of negotiating the PC and all, the amount of PC depends on how much liabilities B is having. But some liabilities are crystallized, some liabilities may be there, may not be there. It's sub judice in the court right now. So A and B are negotiating. B Limited ka owners are telling A Limited that, no sir, you take over our business. E liability will not materialize. Is what B Limited owners are saying. In case if it materializes, in case you suffer a loss because of this, we will compensate. That means, in case this liability is eventually paid by A Limited, in that case, B Limited ka old owners to whom we are presently giving PC, those people are agreeing to compensate to us by reimbursing some amount. So this right to receive money in case I suffer a loss is called as an indemnification asset. Whatever standard says is, is that liability recognized in your books at the time of acquisition? Like this. Yes, sir, we are recognizing. Therefore, you also get a right to recognize an indemnification at fair value only. Normally, if you observe, somebody tells you, in case you suffer a loss, I will come and compensate you. It goes into the zone of contingent asset, because whether I will pay or not only I do not know. So whether I will receive or not also is uncertain. So indemnification asset, how is it an exception? It's actually contingent asset. Contingent asset should not be recognized, but this is an exception. Why this is an exception? Because the related liability is getting recognized. So therefore, asset also they have given exception. So indemnification asset can be recognized when the related liability is also recognized by the acquirer in his books. And indemnification asset, as the name itself indicates, it cannot exceed the amount of liability what you have recognized. Indemnification means compensation for a loss. So you cannot have a compensation recognized at an amount higher than 100. So this can be less than or equal to 100. Sir, they agreed only 60, no problem. Sir, they agreed 120. You have to restrict in this entry only for 100 rupees. Next one is reacquired rights. Reacquired rights is a very easy case. Let's say you are McD. In some country, there is no McD ka chain yet opened. So some X Limited purchased a franchise for 10 years. So that fellow paid money to McD and bought a license to operate under the brand McD and sell the products for a period of 10 years. So at 4 years time, McD now is acquiring X Limited. When McD is acquiring X Limited, in X Limited balance sheet, there is this franchisee intangible asset. That is the brand name, the brand or the license, whatever X Limited intangible asset is there, that is appearing as an intangible asset in their balance sheet. Now McD is acquiring X Limited. When McD is acquiring X Limited, McD will pay purchase consideration to X Limited. As a result of this, the so many assets and liabilities that are there in the books of X Limited will be now taken over by McD. So McD is the acquirer. Whatever standard says, X Limited or whatever assets and liabilities you are taking over, you will obviously incorporate all of them at fair value, the general. But this franchisee is whose franchisee? This is McD ka own brand name. Now McD ka own brand name usually will not appear as a asset in the books of McD, because for the cost is not known. Therefore, India's 38, the second recognition criteria is failed. So own goodwill, own brand, own trademarks, okay, these things are not recognized as intangible assets. But here, our own brand name or our own license is appearing as an intangible asset in the books of X Limited, and I happen to pay PC to X Limited and acquire X Limited. So X Limited balance sheet whatever asset is there, for that also indirectly paid money. So the standard says take it as an exception, recognize your own intangible asset, your own brand name as a intangible asset in your books at fair value, ignoring the renewal rate. Suppose X Limited has a right like this. He initially paid money to us and he has a right to operate the franchise for a period of 10 years, plus he has a right to extend it by another 5 years. So while recording this franchisee as an intangible asset, or A1, A2, A3, so many assets you have acquired, next, this license which is appearing as an intangible asset, that also you recognize. 2L1, 2L2, and why this also should be recognized as an intangible asset at fair value. While determining fair value of any asset, the life of the asset is important. No, the life of the asset you must consider it only as 6 years. Ignore the renewal rates, because out of 10 years, 4 years is over, remaining life is 6 years. Because how can you renew an intangible asset with yourself? So ignore the renewal rates and consider the remaining period and determine the fair value. So after recognizing this franchisee as an intangible asset only, you will try to see whether you are having a goodwill or a bargain purchase. So that is one exception. Next one. The selling company has a non-current asset held for sale, which after taking over, you also have classified it as non-current asset held for sale. And as you all know, India's 105 non-current assets held for sale are recognized in the balance sheet at FELCTS. So you will not today suddenly recognize them at fair value applying the general rule. You will continue to measure them at fair value less cost. The same India's 105 principle will apply. Next, the selling company, the acquiring entity, has got so many employees towards whom, let's say, there is gratuity liability. So in their balance sheet, provision for gratuity is there. And you all know provision for gratuity in accordance with India's 19, how is it measured? Projected unit credit method. You have this step of 4 5 steps now. You will identify the amount of benefit what you have to pay. You allocate cost to every year. Then you compute something called current service cost. Then you build a liability sheet. Then you write entries like current service cost, interest cost to present value of defined benefit obligation, plan assets accounting. So all these are there now. So liability or assets under India's 19 zone, when you are taking them over from selling company and you are incorporating such liability into your books, you will take them over not at fair value but at the value determined in accordance with India's 19. Because when we say fair value, we actually have to apply the definition of fair value as given under India's 113. India's 113 of fair value of an asset is the value what you get if you sell the asset. And fair value of a liability is the amount what you have to pay to some other party for accepting your liability. If you transfer your liability to somebody, to that somebody how much you have to pay, that is a fair value as per India's 113. Don't apply that fair value rule. Apply India's 19 fair value. India's 19 or whatever actual assumptions, so you measure the liability value, consider that only. So that is also an exception. Sir, from the other entity I am bringing their organized skilled force, employees and all are coming and joining in my entity, sir. So for that, in case you pay anything extra, you cannot recognize them as an asset because employees cannot be recognized as an asset because you can't control them. So that's the reason. If you pay anything extra to the other company because their entire skilled force and all is coming, even then you cannot recognize employee or human resource asset as an asset. Therefore, whatever you have paid towards them naturally gets subsumed into goodwill. We can't do anything for that. So that is about assembled. So coming here, the next special case is leases of acquiring. Very easy one. Although you do not have any direct questions or applications on this, so quickly I'll wind it up. Sir, X Limited is acquiring Y Limited. So Y Limited is the acquiring. Y Limited entered into a lease transaction with somebody. So when I say that Y Limited is entering into a lease transaction with somebody, Y Limited can be either a lessee or it can be a lessor. So case 1, let's assume that Y Limited is a lessee. Imagine, sir, Y Limited is a lessee in a lease transaction. Now Y is acquired by X Limited. So who is becoming lessee effectively? X Limited is now becoming lessee. If X Limited is becoming lessee, what entry lessee should record in their books? They should record an entry called as ROU asset account debit to lease liability. So when you write your incorporation entry, that means assets and liabilities incorporation entry, in this assets include ROU asset, in this liability, among so many liabilities including lease liability also. If acquiree is a lessee, acquirer also will become a lessee only now. So therefore create a ROU asset and lease liability. The next question is, sir, at what amount? At what amount is present value of future lease payments on acquisition. So if you are standing on acquisition date, from today, what is the remaining lease term? Whatever are the lease payments in accordance with the definition of India's 116, discount everything to today, whatever number you get, a number to lease liability and ROU asset is today. That's it. This is when, if the acquiree is a lessee. If acquiree is a lessee, you also will become a lessee. The other fellow, some third party, is a lessor. Don't bother about it. So this is one thing. The other case is the acquiree is a lessor. If acquiree is a lessor, again in these two cases, whether the lease is a finance lease, whether the lease is a operating lease. If the lease is a finance lease, the asset prima facie does not appear in the books of acquiree. So there is nothing for you to take over other than the lease receivable. Lease receivable is normal financial asset which anyway will be measured at fair value on the date of acquisition. So the asset under lease will not appear in the books of acquiree. So acquirer need not do any special considerations in this case. Because if acquiree is a lessor, you also will become a lessor. Now you also think like a lessor. So a finance lease, if it is a lease under finance lease, the asset will not appear in your books of accounts prima facie. There is nothing to take over. Lease receivable will be there, that anyway will be measured at fair value. Now if it is an operating lease, the asset naturally appears in the books of the acquiree. And now that you are acquiring that company, the asset will come into your books also. So happily recognize this asset at fair value. So simply put, if the acquiree is into a lease transaction, if it is having any asset and liability, just recognize them in your book at fair value. It's a very, very simple case. Coming to the last aspect here, which is income taxes. On this, independent questions are also there. Even in India's 12 also these are there. Anyway, we'll just quickly tell you. Suppose, sir, A is acquiring B Limited. In B Limited, there are three assets: land and building, debtors, then let us say there is a plant and machinery. But debtors is fixed stock, whose fair values, for convenience assume that there are no liabilities, whose fair values are 100, 60, 200. Now, for this, in B Limited ka tax records, what amounts are there? These amounts only, in our India's 12 language, you call it as the tax. So for this land and building, even though its market value today is 100, according to income tax point of view, its value is 140. Stock value, for convenience, let's assume it as 60. Plant and machinery value, let us say it is 108. Now, these 140, 60, 180 are the tax base. That means for tax records of B Limited, in the tax records of B Limited, income tax purpose point of view, these are the numbers. So in future, for land and building, you can claim, or let's make it simple thing. Let's call it a simple thing. In respect of building, you can claim 140 deduction, stock 60 deduction, plant and machinery you can claim 180 rupees reduction. But their fair values today are so much. Now, tax point of view, what will happen is, let's say the PC paid for this is 500 rupees. So what entry A Limited should record? For a moment, ignore tax and all. So A Limited should record an entry like this: building, stock, plant, at fair values of 200, 60, 200, 260. For all these processes, everything put together, I am paying a PC of 500. So the entry is not tallying. I paid extra consideration of 140. This 140 will identify it as goodwill. Plain sums, this is not wrong. Okay. But what if the question tells you that there is a tax rate of 30%? So now we have to consider tax effects also. Sir, what tax effects are? Look at this. This 100, 60, 200, which are your fair values, this fair value only will now become carrying amount for a limit. These are all fair values only, but they are now becoming carrying amounts. And what advantages or disadvantages you have in taking over this is, apart from you getting assets, you will have some future tax consequences also. So let us see. So your DTA, DTL is carrying amount minus tax base into your tax rate, right? So your total carrying amount is now 360. All assets put together minus tax base. Income tax point of view, if you count this, so 140 plus 60, 200, 200 plus 180, this is 380. This is your taxable future economic benefits. These are your future deductions. So as you can see, if the inside box number is negative, it indicates that I am going to have more deductions in future on a net basis. So I will pay less tax in future. So this will result into a DTA. That means if A Limited takes over B Limited, A Limited will get three assets: building, plant, stock. These three assets we are getting. Not only these three assets, in future, in terms of tax savings, A Limited will get one more advantage called as 6 lakh rupees advantage is there in terms of future tax. In future, tax savings are coming means once upon a time we paid higher tax. Who paid that higher tax? B Limited paid higher tax. Therefore, B Limited will get less tax savings in future. But in future, B Limited will not be there because B Limited is now taken over by A Limited. So B Limited owners are not stupid to not know this. So they know that they will tell A Limited in future you will get tax benefits, so pay us the extra amount also, and they will collect that money also as a part of this PC. This PC is paid not just for your asset processes, it's also paid for a future tax saving. So you tell me now, future tax savings you are naturally getting you are purchasing a future tax saving you purchase the future tax saving, you are paying extra consideration that is included in your PC. So if you do not recognize that, that amount also went and sat under the name of goodwill. So when a future tax saving is there, that DTA must be recognized, and this number should be 130. Sir, what will happen if I do not recognize the DTA? If you do not recognize the DTA, the amount what you paid for future tax saving is getting subsumed into goodwill. Anything that goes into goodwill will stay forever in the balance sheet. So recognize any taxes. Of course, I just took an example of DTA. It could be a DTL also. So DTA or DTL that has to be recognized. Most of the time, in various questions what we have seen in business combination and all, if the question is silent about tax base, B Limited ka what they will give is B Limited ka balance sheet values they are giving in the question. When no information is available, assume that these book values and only are their tax base also. So if the question does not provide tax base of the selling company acquiring entity, assume that their book values only are tax bases. The fair value will become the carrying amount for the purchasing company acquirer entity. So carrying amount ka tax and tax base ka difference is your DTA. So guys, continuing from here, the next step is actually in the order it is non-controlling interest. But before we go into that, let's develop this in a little easier way. Sir, if the business combination type is an absorption type, A Limited absorbed B Limited, B is liquidated, only a big fat A is there, including A plus B combined business. In this case, you will have to compute the PC, compare it with the fair value of net assets. Then, in case PC paid is more than net assets, this result into goodwill. You paid consideration for goodwill. If PC paid is less than the fair value of net assets acquired, then this is a bargain purchase gain, which we will actually show this under capital reserve. Relating to this bargain purchase gain, there is one more point which we will discuss later. So this is one particular business combination arrangement. Imagine I am talking about control acquisition. That means a parent subsidiary kind of relation is getting created, but the other entity, the acquired entity, is not yet liquidated. In that case, suppose you have purchased 70% shares. For that 70%, whatever is the PC you are paying at fair value, you have to consider that. Suppose you are having any existing investment. Today you acquired 70, but already if you are having anything, existing investment in Y Limited, let us say, some 10% you already have. That also you consider at fair value. Then the non-controlling interest. You acquired 70 now, you are already having 10, total you are having 80. The other 20% shareholding in Y Limited, which you don't own, that is called as non-controlling interest. In non-controlling interest also you have to consider here. Here you have a choice. Either you can measure this NCI on acquisition date at fair value or proportionate share of net assets. Now proportionate share of net assets means, so now 70 plus 10, 20, total 100% shares ka value you have identified. This from this deduct the fair value of identifiable net assets on acquisition date. The resulting number, positive or negative. Positive is a goodwill, negative is a bargain purchase gain, which will be transferred and reflected as capital reserve ultimately. Now you observe here. If you say fair value for NCI on the date of acquisition, that means what you will do is, the 20% shares ka market value is what you have to bring and put it there. That's it. No sir, I will do PSNA. In that case, in net assets value whatever is there, on that you simply have to apply 20% for proportionate share of net assets method. Now both the methods are permitted. So the acquirer entity on the acquisition date for determining goodwill, he has a choice of both measuring NCA at PSNA or measuring NCA at fair value on the date of acquisition. And obviously, depending on the choice what you make, this goodwill number will definitely change. Definitely the goodwill number will have an impact because of that. But you must understand, this NCA ICA choices whatever you have, fair value or PSNA, this choice you will have only on the date of acquisition, only on the first day. Once you decide one choice, hereafter on every consolidation date, NCA should not be fair valued. Only subsequent profits per share only we will add. There is no subsequent fair valuation of NCA because NCA is an own equity item from group point of view. Now coming to, imagine there is a goodwill. The goodwill, whatever you get by applying if NCA at fair value or if NCA is 0, then this goodwill is called as a full goodwill. And if NCA is measured at PSNA, the resulting goodwill is called as partial goodwill. So what is the difference between full goodwill and partial goodwill is, in a full goodwill model what you are doing is you are comparing 100% shares ka fair value with 100% net assets of the subsidiary company. So 100% shares versus 100% net assets, the difference is 100% goodwill of the subsidiary which is coming into the consolidated balance sheet. Suppose if you consider NCA at 20%, if you measure at PSNA, then what is happening is only 80% shares are measured at fair value, and effectively you are comparing that with 80% net assets only. So 80% shares ka fair value you are comparing with 80% net assets when if you are doing PSNA. Therefore, the resulting goodwill that appears in the balance sheet is not the full goodwill of subsidiary. It is a subsidiary of, sorry, the goodwill of the subsidiary only to the extent it belongs to parent company ka share. So both the choices are available, but you must be careful. Depending on the choice what you make, the goodwill representation also will change. If NCA is 0, which is 100% subsidiary, in that case also 100% fair value of shares you are comparing with 100% net assets, therefore 100% goodwill will come. Or 70%, 10% is you are holding, 80%, this is anyway to be considered fair value. E 20% shares, even though you are not holding, still if you select fair value choice, then what is happening? Entire 100% shares ka fair value you are considering, comparing that with 100% net assets. Therefore, the goodwill is still a full goodwill. But in case you do this NCA at PSNA, in that case, this NCA is not at fair value. Only these two are fair value of shares. These two, the NCA and the net assets put together effectively is only 80% net assets compared with 80% fair value of the shares in subsidiary. So the resulting goodwill is not full goodwill of the subsidiary. It is the goodwill of the subsidiary only to the extent it relates to parent company share. So this is a story about your goodwill measurement and also NCA ka measurement. Now, suppose sir you did not get a goodwill here. You got a bargain purchase gain, or for that matter here also you got a bargain purchase gain. So general rule is we'll call it as capital reserve. But actually what the standard prescribes is a bargain purchase gain. Getting a bargain purchase gain is rare. Why is it rare? Because bargain purchase gain means you are able to buy the business by paying a consideration less than the fair value of net assets. If the net assets the fair value are 100, which fool will sell the building to you for price less than 100? So it's a very rare circumstance. So standard asks you to reassess everything again. Reassess what? Reassess means what? Again check. Did you consider all the assets and liabilities or not? Are the measurement values correct or not? PC correctly, accurately measured or not? Like that, go and recheck everything. If after reassessment also you say that no sir, bargain purchase gain is there, what should I do? Then the standard asks you, do you know the reason why you got a bargain purchase gain? Reason means, could you identify why the acquiring entity or the owner of the business sold the business at a lower value? There could be reasons like that fellow is in some distress, he is in urgent need of cash, so therefore he sold the business at a lower value, or he is flying off to some other country, so he sold at a lower value, or the business is in losses, so even though the asset value is high, the operating cash flows and all are not so great, That's the reason he's forced into liquidation. Therefore, I went and purchased it. So, if you are able to establish a reason like that, then what our standard says is this bargain purchase gain should be shown or reflected in your OCA section of your statement of profit and loss account, and from OCA section it will fly into balance sheet and gets represented as capital. That means even though goodwill is an asset, that's fine. In case you get a gain, we are calling it as a capital reserve. No, don't call it as capital reserve directly. Go into the SPL OCA section. From there, again take it to balance sheet. Now reflect it as capital reserve. In case you say that sir, no sir, reason adequately could not be identified. In that case, don't show this in your OCA section. Directly go into balance sheet, call it as capital reserve. So ultimately, bargain purchase gain in the balance sheet will become capital reserve. Whether it will come to your statement of profit and loss account into OCA section, and whether it will say hi there or not depends on whether you know the reason for bargain purchase gain or not, depending on that. So this is the story of your NCA and also your goodwill capital reserve. So that is a step number 4 and also step number 6. These two in the order I did not cover. I just covered all the points anyway. Now coming to the PC calculation step. This is important, sir, in this issue are there. Because obviously without PC we cannot work out goodwill capital reserve. So PC calculation. So basically whatever you are giving, let it be shares, let it be securities, let it be cash, let it be deferred consideration, let it be contingent consideration, whatever you are giving, consider the fair value of that. So the fair value of what acquirer is paying, that is the PC. So let's see, fair value of shares issued, fair value of any other security issued, any cash and bank given, fair value of any assets given. Suppose instead of giving cash, you have paid some assets as PC. So asset ka fair value will become the purchase consideration. In case you agreed to pay, but you did not pay now, but you agreed to pay at a later stage. That is called as deferred consideration. So it is a payment only, but it's not paid now, it's paid in future. A promised consideration ka fair value is what, sir? Present value. So if it is a deferred consideration, we'll measure that at present value, because their present value only is fair value there. Next, coming to contingent consideration. Contingent consideration means I promise to the acquiring entity that I will pay you some extra consideration provided, let's say, the profit exceeds a particular limit, or the return, my margin, my returns have my earnings growth rate is going to in next 3 years, something like that. So in the process of negotiation, what happens, sir? The seller will say, the seller company will always try to extract more consideration. The buying company, purchasing company will try to pay less consideration. So selling company says, no sir, we started a new vertical here, this development we have done, because of that in future higher profits will come, so pay us more PC. So purchasing company will say, I will pay you more PC if really that division gives me profits in future. So let's wait for some time. In future, if that particular target condition gets satisfied, I'll pay you, otherwise I will not pay you. This kind of things are called as contingent consideration. Deferred consideration is a definite liability. It is not paid now, it's going to be paid in future. So deferred consideration, contingent consideration, how are they different? Deferred consideration is certain, contingent consideration is uncertain. Any which way, both should be included as part of your PC calculation. There is one more item called as a pre-combination period SBP reserve. This we will discuss later on. Time being, it's not relevant for us. Later on, we will take it up as a special case and we will talk on that. Now, coming to special case, first we will discuss this note point 2. If it's a deferred consideration should be recognized at present value, sir. That's all. If you agreed to pay 1 lakh rupees after 3 years, 1 lakh rupees ka present value, whatever number is there, that you go and include it in your PC calculation. So how will this appear when you are doing the accounting part is, suppose sir, your cash paid right now is 10 lakh rupees. You have deferred consideration. 1 lakh rupees you agree to pay after 3 years. Let's say PV factor 10% I am applying. 10% 3 years. So it's 75,131. I'll leave it 75,000. So your entire PC is 10,75,000. Okay, ma'am. So first entry, business purchase account debit to PC payable, a vendor or liquidator, whatever it depends. You incorporate so many assets to liabilities to business purchase. That's fine. Then when you write the third entry, PC payable account debit to whatever bank you are paying, that you will discharge normally 10 lakh rupees. whatever you agreed to pay, deferred consideration payable. One liability you create and leave it. The liability when you have to pay after 3 years. On each balance sheet date, you have to do unwinding of discount. Unwinding of discount means this 75,000 is present value, no, future value is 1 lakh. So every year interest cost account debit to deferred consideration payable entry you keep on rating till the end of third year, when the 75,000 eventually in your books will become a liability of 1 lakh, on which date you will write deferred consideration payable account debit to bank account and you will settle your liability. This is how you handle deferred consideration. Now coming to contingent consideration. Very easy but important also. Suppose, sir, today is a date of or acquisition date. I tell the acquiring company that let's wait for 3 years. If the growth rate in net profit exceeds 20%, we will pay you some extra consideration. What our standard says is, since this is not a certain amount which you are going to pay, there is no need for you to recognize the entire thing at present value and all. So, for this, go and determine the fair value as on today. So, how will we determine fair value for this as on today? From an examination perspective, you need not worry. Fair value of contingent consideration on the acquisition date, the question will give you. Okay. But if you just want to know how to work out this, I'll just give you a rough idea for this. Let us say you are standing as on today, you want to do the accounting for this entire transaction. After 3 years, standing today, after 3 years, what is the chance of the average growth rate in the net profit exceeding 20%? So, let us say the probability for this is 40%. So, if 40% chance that the condition will be satisfied. So, there is a 60% chance that the condition will fail. So, if 60% happens, I need not pay anything. If 40% happens, then I have to pay something. So, work out an expected value. 40% into the amount plus 60% into 0. Expected value will come. This amount you will discount it to today because you are standing as on today. So, that discounted value is called as fair value. This the question will give you, sir. You need not bother about this. Okay. So, this fair value of contingent consideration should be included as part of your PC. So, contingent consideration payable. So, sir, how to account this? Again, same thing. So, first entry is this, second entry is this, third entry, you will also write 2 contingent consideration payable. With what amount? With the fair value of contingent consideration. So, deferred consideration ka fair value is present value. So, deferred consideration measurement, we did present value accounting. Contingent consideration is not a definite amount, no. So, you should not discount the entire amount. The question will give you fair value along with probabilities and all. They will do all that job. You will not work out. A fair value you take and include it as a part of your PC calculation. That's it. So, on every balance sheet date, what will happen? Now, for that, you need to know something else as well. So, this contingent consideration, whatever you have to pay or whatever you promise to pay, if a particular condition is satisfied in future, you have to go and check whether this contingent consideration satisfies the definition of financial liability or whether this satisfies the definition of an equity. Sir, how can it be equity, sir? Simple, sir. I told you that if net profit growth rate exceeds so and so percentage over a period of 3 years, then I will give you 1 lakh shares. Fixed number of shares will be given to you in future. If I promise to give you fixed number of shares, so that is an equity obligation, no? Obligation, but not a liability, because there is no outflow of resources and all. I need not pay any cash and all. I have to just issue fixed number of shares. In that case, it is classified as equity. If you say that you will pay cash to him on a future date if a condition is satisfied, or you will issue variable number of shares, then it becomes a financial liability. Let it be financial liability, let it be equity. So, initial recognition at acquisition date is done at fair value only. PC law, you will include this at fair value on the date of acquisition only. But on each balance sheet date, you have to apply FVTPL if it is classified as financial item. But if it is classified as equity item, no, so there is no subsequent fair valuation. So no subsequent because it's classified as an equity item. I promised to issue 1 lakh shares. So 1 lakh shares, considering the probability, discounting everything, today's fair value, include that in PC, call it as contingent consideration obligation or contingent consideration payable first day. On every balance sheet date till the actual condition is checked, throughout this 3-4 year gap, never ever fair value provided you classify it as equity. If you classify it as financial liability, you have to apply FVTPL accounting on that. That means what, sir? Suppose you promise to pay 100 lakh rupees. 100 lakhs into 40% plus 0 into 60% expected value discounted to today, some number will come. This will be your liability today. After 1 year, one balance sheet here. Now we are standing here. When you are standing after 1 year, your probability assessments will change. When your probability assessments will change, your expected value will change. Discounting number will change. Earlier you discounted by 3 years, now you will discount it only by 2 years. So by here the number will be different. Already you recorded this. From here to here, whatever gap is there, that will be booked as an income or expense in PRL. Fair value changes, FVTPL. So that contingent consideration, that accounting will be applicable when? Only when it is classified as a financial liability. So that's about contingent consideration. There is one more case, a very interesting case. Look at this. X Limited, Y Limited, 2 entities are there. In Y Limited, 1 lakh shares are there. These people are the owners of Y Limited. So 1 lakh shares are held by X Limited. Sorry, or those 4 people are there. They are holding 1 lakh shares in Y Limited. So what deal X Limited made is, acquires all 1 lakh shares in Y Limited. Fine. So presently 100% shares in Y Limited are held by 4 guys. We pay some consideration to them, and the entire 100% shares in Y Limited X has acquired. So X has obtained control over Y Limited. So X Limited is clearly the acquirer. And we have to pay PC to them. And PC, we have not given them cash. We issued 70,000 shares in X Limited. So here number of shares also I am writing. Here 20 lakh shares are there. So why I am writing X Limited number of shares? Again, don't think that it will become a reverse acquisition case. That's not the case I am discussing right now. Normal acquisition only. X Limited only obtained control over Y Limited, but PC is paid by our own shares. But what I acquired is also shares. So this is called as a share to share exchange. Now, for this transaction, what is a PC? Normal general rule is what? Whatever we give, that is PC. So what is X Limited giving here? X Limited is giving 70,000 shares as PC. So ideally, PC is equal to fair value of 70,000 shares what X has given to the old owners of Y Limited. But what our standard says is, this is okay, but you can also take fair value of what you have acquired if that is more reliably measurable. So you work out 70,000 shares ka fair value. You work out what you have acquired, that shares ka fair value. Whichever is more reliably measurable, you can go ahead with that. So PC always need not be the fair value of what we are giving. Sometimes fair value of shares acquired also can be taken as PC if that is, or that can be more reliably measured than this 70,000 shares ka fair value. So this is an exclusive case of share to share exchange. Here only you will actually do this. So we have a question later on reverse acquisition. Of course, once we break the entire drama of reverse acquisition, when you try to do normal accounting, then this situation will be applicable for that. You will see an example later on. So I'll try to include a question on reverse acquisition, that you will be able to watch this case. So that is that. Then there is an interesting case where it's a business combination transaction, but you have not paid any PC. In that case, how will I account? Sir, how will I get business? How will I do a business combination without paying PC? Look at this. Sir, you are A Limited. There is one entity B Limited. In this B Limited, 1 lakh shares are there. You are holding 40,000 shares. So you are a 40% shareholder only. You don't exercise control on B Limited. So you are not parent. B is not subsidiary. Already said. Now, B Limited buys back 25,000 shares. Are legally not permitted and all. Don't bother into all that legally. If you want, instead of 1 lakh, I'll make it 90,000. Okay. So as a result, what is happening now? 75,000 shares or revised shares in B Limited after buyback is 75,000. If you see now, your A Limited percentage of holding is now more than 50%. Because total 75,000, you did not offer your shares under buyback. So 40 divided by 75, you are definitely majority. Suddenly you observe you are having control over B Limited. So now that you are having control over B Limited, A Limited should go and determine goodwill capitalism. If they have to work out goodwill capitalism, first of all, they should know the PC. But they did not pay anything today. They paid some amount some 4 or 5 years back when they purchased 40,000 shares. So what amount will you consider it as PC? So you should first identify which goodwill template will you use. It is not PC versus net assets the comparison straight away because this is not an absorption case. It's a control acquisition case. B Limited is still alive, parent of the relationship. So you will have to use this template: PC, NCI, fair value of net assets. So whatever 40,000 shares you are having, a 40,000 shares ka fair value today you take. That will be your deemed PC. You did not pay anything. You need not pay anything. You did not pay anything, but still you acquired control. So whatever shares you are already holding, shares ka fair value only will become your deemed PC. NCA, remaining 35,000 shares are there. That either fair value or you have a choice of PSN. Any which way you can do. Net assets anyway you have to take fair value. So that's all. You will go and determine goodwill or capital. Next one, another case. So X Limited, Y Limited, two entities are there. In Y Limited, 1 lakh shares are there. X Limited does not hold a single share in Y Limited also. This Y Limited is into some financial losses and all. So some kind of fraud or something has happened. So as a result, X Limited is asked to revamp the entire activities of Y Limited in the next 2 years. So X Limited has been given full license to operate and direct the activities of Y Limited. So if you see the definition of control, how to obtain that power over the industry, you see some cases where voting rates are also not required, either purely because of a contractual arrangement. X is now having control over Y, but X does not hold one share also in Y Limited, but X is having control over Y Limited. That's all. You are a parent, even though you don't hold one share also. You don't have voting power, but our entire decision making right is there with you because of a contract or statutory reason, whatever reason it is. So X is a parent. So X now has to work out goodwill capital reserve. How will they do? They did not pay PC anything, nor they already have some shares so that I can consider their fair value like how we did in the previous example. So what you will do is PC is 0. NC, entire shares of Y Limited will be grouped under NCA. This you will compare it with fair value of identifiable net assets acquired, and then you determine whether you are having a goodwill or a bargain purchase gain. So even though you do not pay PC, still you may acquire control. In that case, existing shares ka fair value you take. If you don't have shares at all, no problem. PC will be 0. Entire shares of the subsidiary company will be included in NCA, and then we'll compute goodwill capital reserve and go ahead with consolidation process. So these are special cases and all. Next, acquisition related costs. So the legal expenses and all, or getting the assets registered on the name of acquirer and all, whatever costs you incur, all that cost should be transferred to PRL as an expense. See, when an amalgamation happens, when a control acquisition happens, there will be legal expenses, there will be brokerage commissions paid, there will be some registration charges and all. For example, the assets and liabilities are there on the name of other company. Now I have to transfer them into my name. So in the process, I have to pay so many registration charges, stamp duties and all. Nothing can be capitalized. Whatever you pay, Any kind of acquisition related cost will be thrown off as an expense into your PRL. So this is very clear. Do not include this in your PC part. Never ever include these expenses as part of PC. Directly book it as expenditure in your PRL. Goodwill capitalism, already we have discussed all this. So I need not cover all this. These model entries just for discussion sake, so that we'll understand the impacts more clearly. For that purpose I have kept. As such, we have already covered. Sir, I am not saying that you will go and write all these entries every time, but it's just like this. Instead of writing 3 entries, see, business combination account will get cancelled here, the liquidator vendor account will get cancelled here, assets to liabilities to this entire PC, whatever you agreed to pay, net entry. But this will make like, since you are used to this, since you enter, I will give a model entry like this. This also is applicable only in the case of an absorption case. Okay. So here if you see in PC part, if you issue share capital, securities premium, some debentures and all if you issue, cash and bank, deferred payment liability, contingent consideration, if you issue assets, the SBP reserve case is pending, I did not yet discuss it with you. Any expenses and all are there, directly you will debit it off to your PR. Next, coming to a small concept called as measurement period. Suppose A Limited took over B Limited. This is the date of acquisition. On this date, let us say this date is 1/4/2024. So A Limited is writing entry like this: A1, A2, A3, to L1, to L2, to business purchase. This entry A Limited wants to write. As you all know, everything should be recorded at fair value. In the process, fair value of this is 300, fair value of this is 200, fair value of this could not be identified, fair value of this is 100, fair value of this is 50. Now, PC, let us say, is let's say 500, 500 plus 350. So let's say PC is 500. So unless I identify A3 ka number correctly, I will not be in a position to determine goodwill capitalization. But A3 ka fair value I could not identify. I am doing my work in getting the reliable measurement of an asset ka fair value on this date 1/1/2024, but I cannot stop my accounting. No. So what our standard says is, measure this initially at provisional value. Provisional value means okay, reasonable basis. No, measure it. Actual value we will find out and later on we will update. So first use a provisional value. Let us say I have used a provisional value of 100 rupees. As a result, what happened? 300, 200, 100, this is 600. 600 minus 150, liability 450. 450 versus 500. So there is a goodwill now. Okay. This goodwill 50 is a balance. Mind you, ma'am, your goodwill number is not a final number. Why goodwill number is not a final number is your A3 number is a provisional value. Now, what our standard says is, from the acquisition date, you have a measurement window of 1 year. Within the next 1 year, if you bring the fair value of this asset or liability or PC for whatever amount you have used measurement provisional value, a number ka fair value if you bring any time within the next 1 year, we will go and update it. So, let us say on 1/9/2024, A Limited obtained fair value of A3 on 1/1/24 to be not 100, let's say it's 130. What you must understand correctly is, I don't want A3 ka value on 1/9/2024. This is not acceptable. I want A3 ka value on acquisition date only. There is no compromise in this. I'm just giving you additional time period to you to fetch A3 ka value, asset 3 ka value on 1/1/2024. For getting that 1 year time period is given. So you should not bring 1/9/2024 ka A3 value and all. So I want A3 value on the date of acquisition only. This number only I want. So this number only, later on you can bring it to me. Okay. So we originally recorded it 100, but its value on the date of acquisition only is 130. So had I known this number on first day itself, A3 would have been recorded higher by 30 rupees. So debit A3, and consequently your goodwill would have been lower by. So moral of the story is, if you do not know the correct reliable fair value of asset liability of your PC on the date of acquisition, you can include that such amount at a provisional number, and from that date of acquisition the standard gives you a further time period of 1 year within which you can update that number via disturbing goodwill or capital. Sir, what if in next 1 year I am unable to obtain it, I obtain it after 1 year? In that case, you cannot disturb goodwill or capital. You adjust the asset or liability, corresponding impact you have to give it in your reserves or P&L account, but you cannot debit or credit your goodwill capital reserve. If no adjustment can be made to goodwill capital reserve once this 1 year cutoff period is. So this is the story of measurement period. So all this adjusting here. Then we have certain adjustments which are not forming part of business combination. Easy only. Look at this. Suppose X Limited is the acquirer entity. Y Limited is the acquiree entity. So X is obtaining control over Y, absorption, anything, any kind of business combination transaction. Before the business combination transaction, X Limited and Y Limited are having some kind of pre-existing relationship. Sir, what kind of relation? Let's take one example. First one is a non-contractual relationship. Like Y Limited filed a damages case on X Limited for rupees 100 lakhs. X Limited recognized provision for damages at 750 lakhs. Now, X Limited absorbs Y. So between X and Y, they are fighting already. Y is saying that X, you infringe my patents, pay me damages of 100 lakhs. X Limited in their books, they created a provision for damages of 50 lakhs. Matter is pending in court. This case X is now taking over Y Limited. Imagine I am X, you are Y Limited. You filed a case on me. Now I am coming to take over you. If I am coming to take over you, you are already angry on me. You are suing me for 100 lakh rupees. So if I offer consideration to buy you out, then in future this case won't stand because you won't be there. I will become the owner of your entity. So the case will not stand. You will withdraw the case, correct? But you are angry on me. You want to collect money from me. How will you collect that money? So what you will do is, I know why you are taking over. Apart from a business, you will get the legal case dropped also. That's the reason you are taking me over. A feeling you will have. So what you will do, whatever damages you are seeking in the court, that money you will try to take over from me in the form of PC only. So whatever standard says, whatever PC X Limited is paying to Y Limited, this money is not entirely towards business combination. In some amount is towards settlement of a litigation. So we assume that the pre-existing relationship in the form of a litigation is settled at fair value. Fair value of this damages means in your books liabilities are appearing at 50 lakhs because you created 50 lakhs provision on the last balance sheet date. Today on the acquisition date again re-measure it. What is the realistic situation of settling it? So fair value of damages is 60 lakhs. So we imagine that suppose your PC is 600 lakhs or let's say 800 lakhs. So what we believe is X Limited anyway has to pay to Y Limited an amount of 60 lakhs. Now X is actually paying an amount of total 800 lakhs. So how you have to imagine is 800 lakhs is the total consideration what X is paying to Y for business combination also plus for settlement of damages also. So, but for your goodwill calculation and all, the amount what you pay for damages and all, that is not your business combination transaction caprice, you know. So I want the PC exclusively paid for business combination. So I want only PC for PC. Overall I am paying 800. It is assumed that the existing pre-existing relationship between acquirer and acquiree, which is non-contractual in nature, is deemed to be settled at fair value on the acquisition date. So we believe that in your 800 lakh, 60 lakh rupees we are paying towards damages. So 800 minus 60, effectively 740 lakhs only is your PC. So your entire goodwill calculation and all will happen only with an amount of 740. 60 lakhs is what you are accounting for your damage settlement. India 37 will apply. Already you created provision of how much did you create provision? 50 lakhs is there in your provision. Now you are settling that at 60 lakhs. So extra 10 lakhs of the debit to P&L account and pay bank. That's it. But towards BC, entire 103 accounting, you have to consider PC as only 740 lakhs. So, sir, so can I say like this? If acquirer has to pay, and acquirer is now taking over the selling company and we are paying PC. So whatever I have to already pay is now included indirectly in the form of PC. So we have to remove it. Sir, what if acquirer has to receive? So imagine, instead of Y Limited filing a case on X Limited, X Limited only filed a case on Y Limited. Later on, X Limited is now trying to acquire Y Limited. X Limited is trying to buy out Y Limited. So how X Limited will think? I filed a case on this fellow. Matter is pending in court. Now I am trying to take over. If I take over, there is no case only. So whatever I have to receive from Y Limited, I will not be able to receive. So what X Limited will do? If Y Limited ka value, business value is 1000 lakh and I am seeking 100 lakh damages, what I will do is X Limited will go and pay PC of only 900 lakh. Because anyway 100 lakhs I have to receive from you, you won't pay me. So now I will pay you less PC. So just because I am paying you 900 lakhs, in 900 lakhs will not become the actual PC for your BC. Actual PC for BC is 900 lakhs plus the extra amount what I netted off. So here we have deducted this. From the overall consideration, fair value of damages payable we are removing. In case we have a damages receivable, in that case what I would have done is 800 plus 60, answer would have been 860. So what you have to check is whether the acquirer fellow, he has to pay or receive. If he has to pay, he is paying it. It's included in PC. If acquirer has to receive, he will not explicitly receive it. So therefore, he will reduce and pay the net PC. Since PC is already reduced, you have to gross it up to get the correct PC for this. So that's what I've written here. If acquirer has to pay, deduct such amount from agreed PC. If acquirer has to receive, add that to agreed PC. This is when, sir, if it is a non-contractual relationship. Sir, what if this is a contractual relationship? Contractual relationship means there is a contract between two entities. Now look at this. X Limited, Y Limited. They agree into some purchase contract. That means X will buy 20,000 units per annum at the rate of rupees 50 per unit for 5 years. This is the contract between X Limited and Y Limited. Now, 5 years contract. Sir, the price is fixed. Contract is going to be, goods are going to be purchased by X Limited at 50 rupees. Y is going to sell them at 50 rupees. Now, at 3 years time, X Limited wants to take over Y Limited. Some PC amount. Now, X takes over Y Limited, PC offered is some amount, all that is fine. But this contract you see, now X and Y are two different entities. So there is a contract. One party will be winning, one party will be losing because price is already fixed. But if X Limited absorbs Y Limited, in future there will be only one party. Correct? Now, the party who is gaining or losing, the selling company or the purchasing company, the advantage or disadvantage in this contract, that will not be there in future. Let us say example. As on today, market price of unit is 30 rupees. Let's say 60 rupees. Market low, sir, the price is, let us say, convenient, 40 rupees. So if X Limited wants to buy this unit in the market, ignoring this contract, they can buy this in the market at 40 rupees only. But under the contract, they agreed to pay 50 rupees. So who is feeling good, who is feeling bad? X Limited is feeling sad, Y Limited is feeling happy. Purely because of the contract. Now X Limited is trying to take over Y Limited. Now if X Limited takes over Y Limited, the price advantage which Y Limited has because of the contract today, which is valid for another 2 years, advantage Y Limited will not receive. X Limited is sad now and he will say I will smile because the contract will be cancelled. Hereafter Y Limited will not be there, I will acquire Y Limited. But when you try to offer PC to Y Limited is not stupid. Now what Y Limited thinks, if you don't take over me, if we both remain independently, the advantage what I had, I would have enjoyed. But if you are taking me over today, X Limited, you have to pay me something. So what you have to do is, what our standard says is, the contract is deemed to settle at amount to the extent it is unfavorable or favorable to acquirer. Think only from acquirer point of view because you have to apply this entire acquisition method only in the books of acquirer. That's right. So acquirer point of view, e contract is favorable or unfavorable. Suppose in this case, acquirer in the market can buy at 40 rupees only, but under this contract he is buying at 50 rupees. Therefore, it is unfavorable for him. The fellow is crying. So go and measure to what extent this contract is unfavorable for him. Let us say, simple measurement, 20,000 units, per unit 10 rupees loss, so 2 lakh rupees loss. 2 years another contract is valid, so 2 years into 2 lakh rupees, ignoring present value, I am just calling it as 4 lakh rupees. So if this fellow is sad for 4 lakh rupees like this fellow is also happy for 4 lakh rupees, no? If X Limited takes over Y Limited will not enjoy that advantage. So what Y Limited will do? Pay me that amount as a part of PC. Otherwise, I will not get sold to you. So what our standard says is, it is deemed to be settled at this amount. But since it's a contractual relationship, there may be a clause of cancelling the contract. So penalty for cancellation. Sometimes contracts have this clause. So go and check if there is any cancellation penalty. Suppose cancellation penalty is there, 1,50,000. Standard says whichever is lower. We believe that between you this contract is closed at an amount whichever is lower. So you cannot argue that the loss to X Limited is 4 lakh rupees, because if really the loss to X Limited is going to be 4 lakh rupees, X Limited will not execute the contract. No, he'll pay penalty and get out of the contract. So now I can say that the benefit to Y Limited and loss to X Limited is only 1,50,000. Therefore, X Limited has to pay 1,50,000 to Y Limited for closure of this contract, and they have already paid that and included it as a part of PC. So from your total PC, you have to remove. Cut 4 lakh. This is unfavorable. If this was favorable, then I would have added this lower number to my PC, depending on whether acquirer entity has to pay or acquirer entity has to receive. Depending on that, I will decide whether I have to add or minus. So what is the difference between this one and the previous one? Previous one is a non-contractual relationship. It's a legal litigation case. So in this contract, cancellation penalty and all will not be there. No. So it's assumed that this is closed at fair value on the date of acquisition. Since this is a contractual relationship, whether this contract is favorable or unfavorable, you have to check and also see if you have to cancel the contract, is there any damages? Whichever is lower, a lower amount, the contract is deemed to be settled. So this is how you handle it. This is an important case. Next. Sir, A Limited absorbs B Limited. B Limited ka business is entirely new for A Limited, but they have taken it over. There is one shareholder, Mr. B. This Mr. B is a 60% shareholder. He is also the CEO of this company. A Limited now take over B Limited. So we paid some consideration to this guy because he is a shareholder. But what we asked is, Mr. B, you continue as a director in A Limited after the absorption. So Mr. B will continue as a director in A Limited after absorption. Fine. Why A Limited wants that fellow as a director? He knows the entire in and out of B Limited. He has been CEO of that entity. I am new to that business. I want that fellow to smoothly handle B Limited's business under the name of A Limited hereafter. Meanwhile, we will also see and observe and we will learn. The condition, now the question is, whatever amount A Limited pays to Mr. B, is it part of PC or not? That's the question. Who is Mr. B? Mr. B is the old shareholder of B Limited. He is also now a employee in A Limited. So whatever amounts we are offering to Mr. B, should it be forming part of PC or not? Further, the answer depends on you are paying money to Mr. B in what capacity. If you are paying money to Mr. B in the capacity of a shareholder of B Limited, then that is definitely part of purchase consideration. But if you are offering some consideration to Mr. B just to continue in the employment of A Limited post the business combination event, in that case, that is an amount paid to an employee. It's covered by India's 19 employee benefit, and this is definitely not part of your purchase consideration to be included for business combination activity. So whatever consideration you pay to him, go and see, are you paying that to him in the capacity of shareholder? Are you paying that to him in the capacity of employee? If any consideration is offered to Mr. B and that will be terminated if he leaves the employment, that means you are paying that to him in the capacity of employee. That amount of consideration cannot be included as a part of your PC. So don't include that amount. On this also applications are there when you do the big questions under business combination. There is an interesting restructuring agreement. This is also a special case. On this directly we do not have an examination question till date, but in IFRS there is an application on this. So watch out for this one. So there is B Limited. In B Limited balance sheet, so many assets are there, so many liabilities are there. Among so many liabilities, okay, let me reiterate this. B Limited is a company, and now A Limited wants to take over B Limited. What A Limited did is, B Limited, the way in which you are conducting your business is not good. So once I take over you, I will have to restructure the entire business. That means I have to shut down some divisions, I have to withdraw some products, I have to remove some of the employees, I have to do all that. Then I will have to change the way in which the business is conducted. Then only we believe that this business will run into profits. So if I am taking you over, I am taking over this business with the intention that I will restructure this business, make it profitable. With that plan, I am taking you over. B Limited said, do whatever you want, pay me PC, I will get out. Then A Limited told B Limited one small thing. What is that? Once I take over you are a loss-making company. Once I take over you, all your employees and all will be thinking that I will do some extraordinary wonders inside A Limited under my management. But actually what I am going to do is I am going to shut down some divisions. I am going to withdraw some products and services. I am going to remove a lot of employees. So this is my plan. If I do that, it will not send a good signal. So what condition I am putting in front of you is, A Limited is holding the hand of B Limited and saying that B Limited will now go for a restructuring exercise. Actually, B Limited does not have any plan of doing a restructuring activity. A Limited made B Limited do a restructuring activity because they put it as a condition for this deal of A Limited taking over B Limited. As a result, B Limited detailedly made a formal plan of restructuring, announced everything. All this plan, everything A Limited only give, but it's happening through the mouth of B Limited. As a result, what happened in B Limited balance sheet? They created a restructuring provision. Actually, who wants to do restructuring? A Limited wants to. But who announced the restructuring plan? B Limited, because of the condition kept by A Limited. Now what happens is, now A Limited took over B Limited. The process of what happened is, so many assets, so many liabilities, provision for restructuring, to business purchase, the balance will be your goodwill or capital reserve. Whatever standard says is, this liability, whatever is appearing in the books of selling company B Limited, this liability is actually not their liability. This is a liability which A Limited has to recognize in their own book, because A Limited wants to do restructuring, not B Limited. But you made B Limited enter or announce a restructuring plan, and consequently B Limited balance sheet they have created a restructuring provision. If you take over that here, this will go and impact my goodwill. How can a post-business combination activity, which A Limited wants to do for its future conducts of business, can decide the amount of goodwill capital reserve as on today? So this cannot be incorporated. Imagine, sir, the same thing happens very straightforwardly. B Limited has so many divisions, loss making and all. Imagine A Limited took over as it is. After taking over, A Limited announced the restructuring activity plan and all. Then A Limited should have recorded this entry, no? P&L account debit to provision for restructuring. A Limited should have recorded this. And assets to liabilities to business purchase entry, the provision for restructuring will not appear because it was never announced by B Limited. So goodwill capital reserve calculation should not be impacted by restructuring provision. But for so many reasons, if A Limited makes B Limited start the restructuring activity and later on take over B Limited, in that case also don't include this here. You normally write the entry without writing restructuring provision. Restructuring provision, as usual, you record this. So this is the story for restructuring. No, sir, our case is not like this. B Limited on their own, they went into restructuring. They announced a restructuring plan. The restructuring provision also created. Later on, I happened to take over B Limited. In that case, yes, you can happily take over restructuring provision also as a part of your incorporation entry. Let it impact the goodwill capital. So whether restructuring provision of the acquiree, will it be impacting goodwill or not, depends on who initiated it. If selling company initiated that on its own, then no problem, you can take it. But if purchasing company made selling company initiate it, then you cannot incorporate it and let it impact your goodwill capital reserve. So this is one good case what we have, restructuring arrangement. Then we have share based awards. So very interesting case, very easy case also. Now guys, coming to share based awards, it is very easy case guys. Look at this, there is a company called B Limited. There are employees in this to whom B Limited has issued ESOPs. ESOPs have a vesting period of 5 years. So after 5 years, these employees can exercise the options. After 2 years, example number 1, A Limited absorbs B Limited. What is the meaning of absorbing B Limited? B Limited entity is liquidated and now the entire ownership of the business of B Limited is now under the hands of A Limited. So imagining that the employees also will continue. So therefore A Limited has to replace the ESOPs. Once upon a time these employees will have the right to buy shares of B Limited, but B Limited entity is liquidated. Now these employees cannot have the old ESOPs, no, their ESOPs have to be replaced by A Limited. So they should have the right to buy A Limited share and not B Limited share, because B is not there anymore. So A will replace it. So how A Limited has replaced it? Imagine total vesting period is 4 years. Therefore the remaining vesting period is equal to 2 years only, because they have already served 2 years in the past, another 2 years of use, so that's enough. But as per the original plan, it is 5 years, remaining is 3. But now A Limited has issued new plan, therefore they have changed the terms and all. Now what you have to do is determine the fair value of new share based awards, that is new ESOPs. Replace ESOPs. So let us say this is 500. This new ESOPs, whatever A Limited has issued, are new ESOPs, the fair value of identity. Because today only they are replacing on the acquisition date acquisition date का fair value work out. This is also the grant date for the new ESOPs. Now, ESOPs has a remaining vesting period of 2 years. After 2 years, when employees will have right to buy the shares, by that time, A Limited in their books should have SBP reserve of total 500 lakhs. When not today, after 2 years. But these employees have already rendered some services till now. Since already they have rendered some services till now, on the acquisition date only, this A Limited has to create some SBP reserve. Some they will create in the next 2 years. So, how much is towards pre-combination services? Pre-combination is before business combination services. How much is this? How much of this 500 lakhs is towards post-combination services? So employees will further render services over a period of remaining 2 years. No, split that. So how will we split this amount? For that there is a formula. Fair value of existing awards. Existing award means not what A gave to employees, what originally B gave to employee. A ESOP का fair value you bring into vesting period completed till date divided by original vesting period or revised vesting period, whichever is higher. This is the formula given. Fair value of existing award. For example, this old awards which B has given to these employees once upon a time. So imagine that fair value of existing awards is, let us say, 400. So this 400 into till how much period is completed? 2 years divided by original vesting period, which is 5 years, or revised vesting period 4 years, whichever is higher. So 400 into 2 by 5, so that is 160. So what our standard says is, 160 rupees, which is the value of services obtained up to the date of acquisition, toward up to the extent of this amount, create a SBP reserve on the acquisition date. And so how will you create this? What is the debit portion? Credit SBP reserve. Debit what? Nothing, sir. This you have to include in your PC. If you include this in your PC, a PC discharge entry, instead of PC discharge entry, how will we write 2 cash, 2 equity share capital, 2 securities premium, like the 2 SBP reserve. 1 SBP reserve you have to create that. But my entire new ESOPs ka fair value is 500 lakhs. What you have to understand is, the total SBP reserve is 500 lakhs. Out of that, for the services what you people have already given to me till now, towards that, right away we will create SBP reserve of 160. Remaining amount, whatever is there, this I will create, which is 340. This we will create over remaining vesting period of 2 years. So this is how you have to do. This is which case? When ESOPs are replaced. Replaced means old ESOPs are cancelled, new ESOPs are issued. When old ESOPs are cancelled and new ESOPs are issued, pre-combination services kit, you just apply this formula. Whatever answer comes, that answer go and include it as a part of PC and consequently create a SBP reserve. Now how will this look is, just for understanding, one small example. Suppose the PC what you are paying is 1000. Sorry, this is the cash PC what you are paying is 1000. Now this pre-combination services ka value you measured at 160. So total PC is 560. So what you will do is, business purchase to PC payable first entry with an amount of 560. Second entry, so many assets, so many liabilities, to business purchase, this amount will record with 560. Just for understanding, I'll directly write net assets. Let us say net assets is 500. So this gap is good. Now, the PC payable discharge entry will be there. In that PC payable entry, 560. Anyway, you agreed to pay cash of 500, pay that. But not 400. The 160, the process of discharge, you will create a SB. So on the acquisition date only, in the acquirer fellow's balance sheet, you are outrightly creating SB reserve of 160 relating to pre-combination services. For the next 2 years, put together anyway I have to create 340. Assuming straight line, like the employees to change and all is not there, 170, 170 I'll create in the next 2 years. So by the end of second year, 160 now, 340 in the next 2 years, eventually 500 rupees SBP reserve will be appearing in my balance sheet after 2 years by the time options get vested. So this is the story, sir. Here one doubt students usually have, that is, sir, why should I take whichever is higher? Because you are ultimately taking denominator of 5. 5 is the vesting period original ESOP. But original ESOPs are cancelled now. New ESOPs are there. New ESOPs, the vesting period is not 5, it is 4. Why are we taking higher number in the denominator? Listen, ma'am. For this, it's a very simple thing. It's a pure mathematical thing. Sir, when you write this entry, you will record every asset, every liability that can be identified. In fact, we have seen in the exceptions also, we went to the extent of making exceptions. We started recognizing some indemnification assets. We started recognizing some intangible assets which are not recognized by the selling company in their books. We even recognized in-process research work also, which does not even qualify the definition of asset. Even then, in-process research WIP and all, we have recognized as asset. Why? Why did we do all that? Because if we identify every asset, every liability possible, then only you will be able to measure the correct amount of goodwill. And goodwill cannot be identified. That's why we try to measure everything and then get the amount of goodwill. Correct? So, and goodwill cannot be identified, cannot be verified. Now, goodwill amount is the least trusted amount in the balance sheet. Now, here you observe. Suppose, because 5 is technically incorrect, because ultimate ESOP's vesting period is not 5, it's only 4. I ignore 5 and I take 4 only. That means I will take 400 into 2 by 4. I will have an amount of 200. What will happen? My PC will be, this is 400, this is 200, this will be 600. First entry I will record with 600. The entry also will record with 600. Here the moment I write 500, my goodwill number will be 100. So if you take the lower number in the denominator, here the denominator, if you take a lower number, then your pre-combination services ka value will be higher. A services ka component, how will you value, sir? Sir, what is the worth of services received? You do not know. That is only an arbitrary number. It can't be reliably measured. Indirect valuation, sir, value of services directly, since it cannot be measured only, we are taking the value of options and then we are measuring it. Adhe indirect valuation. So whatever services are already consumed, if you unnecessarily take a overvalued number, that's ultimately inflating my goodwill, which I don't want, because that number cannot be verified, that cannot be identified, that cannot be amortized. That's the reason. To keep the ultimate goodwill number under check, this number should be lower as possible. If the ultimate number should be lower, the denominator should be higher. If you tell me, sir, my revised vesting period is not 4 years, sir, it is 8 years, then also I will take only 5 years. I will not take 8 years, sorry. Then I will take 8 years, not 5 years. Sorry. Whichever is higher, I will take. So it's not about I will take original vesting period ka denominator. It's not like that. Here, yes, ultimately original vesting period ka denominator got selected. But if you make it 8, this will get selected. Okay, so whichever is higher, my goal is simple. It is service valuation, which is arbitrary indirect valuation. Service valuation, if it is kept low, goodwill also will be kept low. Service valuation, if you increase it, goodwill also will get increased. I don't want it to increase an unverifiable asset like goodwill. Therefore, this service valuation, I want to keep it low. That's why denominator, the standard is asking you to take whichever is higher. So that's the logic for this case. So this is when you have replaced. In a absorption case, same story, look in a different scenario. A, B issued ESOPs to their employees. To these employees, B has issued ESOPs. A did not absorb B Limited, A purchased 70% shares in B Limited. So B Limited is not shut down. B Limited is existing as an independent entity. A Limited is also anyway existing on its own. Here both possibilities exist. Possibility 1. A Limited replaced the ESOPs. A Limited says, I am the bigger entity. I am the flagship company of the entire group. The employees will be more motivated, more happy if they have right to buy shares in A Limited rather than their existing right to buy shares in B Limited. So A Limited says, subsidiary company, we will cancel your ESOPs and I will issue my ESOPs. In that case, what to do? Whatever we did above, same as above. So all you have to do is, in new ESOPs ka fair value workout, make it into two parts: pre-combination, post-combination. Pre-combination services ka number will be the fair value of existing awards into vesting period completed divided by original vesting period or the revised vesting period, whichever is higher. That number you will go and add it to PC, that's it. Same thing here also you will do, no change. Possibility 2. A Limited does not replace the ESOPs. It may make changes to vesting period and other terms. It is possible, but A Limited says, remaining vesting period is how much? Employee says are 3 years, sir. No, remaining vesting period is only 2 years. A Limited is the boss now. A Limited is controlling. But after 2 years, A Limited won't issue shares. B Limited only will issue shares. That means ultimate obligation to issue shares is there on B Limited only. A Limited is changing some terms and conditions of the ESOP. It can change, it may not change. But the ESOP's obligation is not taken over by acquirer. ESOP's obligation is still there with B Limited only, the acquiree only. In this case also, you will do computation same as above. Determine the worth of pre-combination services and include this in C. So same calculation. Earlier also pre-combination services you valued, now also pre-combination services you value. Earlier when you valued it, you did it because you are replacing it, therefore PCL I have included. This time I am not replacing it. Sir, then why did you value? Why I have valued is, these fellows are not just employees, they are equity instrument holders. So whatever status equity shareholders of B Limited will have, even these fellows also have the same value. But so whatever pre-combination services worth is there, since I am not going to pay, since A Limited is not going to pay for that, A Limited will not include that in PC. But ultimately, these buggers will eventually become the shareholders of B Limited. And once they become shareholders of B Limited, any shareholder in B Limited other than A Limited are who, sir? NCA. Today, what is your NCA percentage is 30%. Apart from the 30%, even these fellows ka pre-combination service, to that extent, that number also must be added to the NCA. Because they are not just employees, they are employees with a paper called as ESOP, therefore they become equity instrument holders, and therefore the pre-combination services ka value must be treated as portion of NCA. Now if you watch your goodwill, in this acquisition model goodwill template, PC, NCA, fair value of net assets. This is your goodwill number. If it is replaced, you will add it here. If it is not replaced, subsidiary company only is going to issue ESOPs to their employees. In that case, you will add here. Absorption case, replacement is compulsory, sir. You cannot have B Limited issue ESOPs to their employees because B Limited is closed here in the previous example. So it works with that. So moral of the story is, you first go and work out pre-combination services ka value. Then check whether it is replaced or not replaced. Replaced, add to PC. Not replaced, add to NCA. That's it. So as simple as this. All you have to remember is one formula and go and check whether the word replaced is there in the question or not. If it is there, add it to PC. Not there, add it to NCA. That's it. This is the story of your share-based awards, guys. So that's what I have given here, sir. Share-based award. One formula for pre-combination services, post-combination services. So you just have to see whether it's getting replaced or not. If it's getting replaced, add it to PC. Not getting replaced, add it to NC. Then we have piecemeal acquisition. This piecemeal acquisition is nothing but part acquisition, sir. In substance, I have already discussed it with you, but I'll just quickly go through this example once again. One small example I will take later on in the questions also. One model is there. Sir, A Limited acquired 30% in B Limited. 30%, so usually significant influence will be there, but control will not come. Subsequently, A Limited acquired another 70%. Therefore, control is obtained. Since control is obtained, this is a BC transaction now. Therefore, we have to determine goodwill or capital. Now, before you acquired this 70%, in the balance sheet of A Limited, we will have investment in B Limited, which is measured at equity method. Why is this measured at equity method? Is with 30%, that's a significant influence. B Limited is an associate, therefore you would have applied equity method. Suppose your cost once upon a time is 100 lakhs. Equity method, what we will do is we will add the post acquisition profits of B Limited and you add that to investment and also to your profits also. Let us say post acquisition PRL, in this sum 3 lakh rupees we have added. Post acquisition revaluation surplus, let us say another 2 lakh you have added. So total this investment today in your books is appearing at 105. E3 and 2 are not your profits, they are profits of B Limited. B Limited profits is 30% you added to your investment. Correspondingly, you would have added into your retained earnings. In your retained earnings plus 3 is there. In your OCA section, revaluation surplus, to your revaluation surplus, this 2 also is there. So even though originally you purchased it for 100, because of application of equity method, extra profits of the associate got added into your investment also, to your reserves also. This is status. E stage, the A Limited acquired another 70% in B Limited. And now control also is obtained. Now whatever standard says is, the investment whatever is appearing at 105 today, that investment cannot appear in future anymore, because that fellow is becoming my subsidiary. No, so in consolidated books of accounts I cannot show investment in subsidiary. So what you have to do, you have to cancel this investment. Not only you have to cancel this investment, goodwill capitalism step I told you that any existing investment must be considered at fair value. But this 105 is not fair value. 105 is the value that is appearing in our books of accounts after applying equity method. So first and foremost thing what we will do is investment in B Limited account of it to here. So you update it. So fair value the existing investment. So let's say fair value is 150. So 45, 45. 150 minus 105. So investment 105, it now became 150 in my books. Now what you will do is goodwill capital reserve, now parent subsidiary relationship, no. PC what you paid for your 70% shares today. Let us say you paid 500 rupees. Fair value of existing investment 150. NCA 0. For convenience I assume NCA 0. Fair value of net assets 450. So 200 rupees cost number came. This is a goodwill. Right, sir. Now coming to accounting part. So many assets, so many liabilities. Directly I'm writing net assets account debit 450. To bank, today I paid 500. The investment existing one is there. That investment cannot appear in my books. That should die, sir. That was actually appearing only at 105. I fair valued it to 150 and now I'm cancelling that investment. If at all NCA is there, I'll create NCA also, but in my case NCA is not there. And therefore goodwill will come out as a balancing figure 200. The entry only we are translating this into a statement only, working note only, we are translating that into a journal entry. So that is investment. First investment you update it to fair value, and that investment you are cancelling it here. When investment cancelled completely, investment related OC item cannot be there because it's as good as the gain is realized gains. So this revaluation surplus cannot exist now. So cancel it. So the entry should be revaluation surplus. It's a OC item, and revaluation surplus cannot be reclassified. So this should be merged directly into whatever number that is. Suppose if it is not revaluation surplus, it is FCTR reserve created under Ind AS 21. That's a reclassifiable item. So in that case, my entry should have been FCTR account debit to PRL. So whether it will go to PRL or retained earnings side depends on whether reclassification is permitted under the standard or not. For revaluation surplus, it is not permitted. I'm directly merging it off into retained earnings. So this is how you deal with piecemeal acquisitions. That's all, sir. We have pretty much covered all the concepts relating to straight acquisition method. Now coming into next aspect, which is called as common control transaction. Common control transaction means it looks like a business combination arrangement, but before and after the arrangement, the control is there with the same party. If the same person controls the business before and after the arrangement, it is called as common control transaction. If you establish any transaction as a common control transaction, all you have to do is apply something called as pooling of interest method. You cannot apply acquisition method. The pooling of interest method, we have heard it somewhere before. Where, sir? AS 14. All the assets and liabilities should be taken over at book values, carrying amounts. Any difference should be adjusted only into reserves and surplus. This kind of accounting we will do. We will not incorporate anything at fair value. We will not create goodwill at all. So the acquisition method, what we learned till now, this acquisition method you should not apply if it is a common control transaction. It's a pure business combination transaction, acquisition method is okay. Otherwise, acquisition method is not okay. So common control transaction. So common control transaction example. So A Limited holds 80% shares in B Limited. So A is parent, B is subsidiary. Now I'll tell you that A absorbs B Limited. A is absorbing B Limited. Somebody only watches this. Sir, A is absorbing B Limited means A gets control over B Limited, therefore it's a business combination transaction. True. But already A is having 80% shares in B. A is already controlling B. That means what? When A acquired 80% shares in B, already we would have done the entire exercise of acquisition method. You would have measured everything at fair values on that date. You would have already determined goodwill and all. If you again apply acquisition method, what will happen? Again you will fair value the assets and liabilities. Again PC ka fair valuation will be done. As a result, what will happen? Goodwill number will change. That means you are going and disturbing self-generated goodwill, which is already created. That goodwill ka value you are changing again. That cannot be done. That's the reason acquisition method should not be applied. In this another, so many models are also there. X is having two subsidiaries, Y and Z. Now I will tell you that X Limited sold investment in Y Limited to Z Limited. So ultimately how it looks is X is having shares in Z, Z is having shares in Y. If you observe only this part, Z obtained 80% shares in Y Limited. Z acquired control over Y Limited. True that is. But Z and Y both are under the control of X Limited. Before the arrangement, after the arrangement also. So again this is a common control transaction. Next. This is X Limited. This fellow is having two divisions, division 1, division 2. Here we are making chocolates. Let's say here we are making some perfumes. So what X Limited did is, X Limited only created one more entity called Y Limited. And to this Y Limited, they transferred this perfumes division. So all the net assets disappeared here and they are coming here. Y Limited newly formed company, no? X Limited made, Y Limited issued shares to it. So X Limited is now having investment in 100% shares of Y Limited. Observe close. Is there a transfer of business? Yes. Division 2 perfumes business Y Limited to be sold off. As a result, what did we get? Cash. Not cash. What we got is shares. In such a way that X Limited is now controlling Y Limited. So think from business point of view. Earlier, both the businesses are under the control of X Limited. Now, X Limited is doing only chocolate business. Perfumes division is carried on by Y Limited. But Y Limited shares are held with X Limited to such an extent of 100%. So, X Limited is still controlling the perfumes division of Y Limited. This is again a common control transaction. The most common control transaction from your examination point of view is this, which is a demerger case. This above example is not demerger. This is a sale of division. This is a demerger case. This fellow is having two divisions. One is mobiles division, one is laptop division. A Limited, what it has done is, this laptop division, they have transferred it to B Limited. So, laptop division, assets, liabilities, everything will go into B Limited. B Limited is a newly formed company. It issues shares, not to A Limited, but to shareholders of A Limited. So, these people are shareholders of A Limited. This B Limited is now issuing shares to them. As a result, these people now also become shareholders of B Limited also. Among these shareholders, obviously generally in company there will be some group of controlling shareholders. No? So this fat fellow is a Bahubali shareholder. He is having 70% shares. So this fellow, this fat boy was controlling mobile division, laptop division before demerger. After demerger, he is a 70% shareholder in A Limited also, B Limited also, and therefore he still controls laptop division after the demerger also. So this is a demerger, but a demerger with common control. Of course, demerger can happen without common control also, but demerger happens without common control, then definitely B Limited will apply acquisition method accounting because they are properly acquiring a business, but not in this case because the same parties are controlling the business before and after the arrangement. These are examples of common control transactions. So if it's a common control transaction, how do we account it? For that you have to apply pooling of interest method. I will roughly tell you how pooling of interest method works, then later on I will link it up with whatever you have studied in your CNT. So we don't use the word acquirer, acquiree. We call it as transferor and transferee. Transferor means the entity which is giving away the business. Transferee is the entity which is taking over the business. So the entity which is giving away the business, life is very simple. You simply have to remove the cancel the assets whatever are transferred, cancel the liabilities whatever are transferred. In case you receive any PC, so PC receivable. It may not be there in some case. For example, look at the last scenario. Whatever net assets are there relating to laptop division, A Limited has to derecognize. But A Limited does not have a PC receivable right there because PC is paid by B Limited directly to the shareholders of A Limited. So A Limited may not receive anything. But look at this example. X Limited transferred the perfume division, but in return it is receiving some PC in the form of shares in Y Limited. So if he is there, you will write. If it is not there, you will not write. Simple. Sir, assets and liabilities, since you have to cancel them and kill them, you have to obviously derecognize them by writing the amounts at carrying a value only. So, any difference is adjusted to capital receipt. upside, downside, gain, loss. Adjust it into capital reserve. Sir, in our books, capital reserve is not there, sir. Loss is there now. Show negative capital reserve. No problem. There are so many alternative treatments, sir. Anything is okay, but don't go into PRL. Directly adjust into balance sheet reserve. Equity. Other equity only after. Coming to transferee point of view. Whatever assets, whatever liabilities this fellow is giving away, that you have to recognize now. Recognize. So assets to liabilities. You have to pay PC, sir. Either to vendor company or shareholders of that company or to somebody you have to pay PC. But here you have to recognize only at carrying amount of transfer. You cannot recognize these amounts at fair value. Incorporation entry, but you cannot bring fair value. Because if you bring fair values, you have to create goodwill. I am anyway not going to create goodwill because control is not changing hand. Same parties are controlling. You just created another copy or another pocket where you are keeping some of your assets and liabilities. This is not called as a business combination transaction. Therefore, goodwill cannot be created. Since goodwill is not created, assets and liabilities are not recognized at fair value. Sir, but the entry is not tallying, sir. Does not matter. Upside, downside, any difference is adjusted into capital reserve only, whether here or here. Don't use fair value. That's it, sir. This is how common control transaction is accounted. So, the transferor company will remove assets and liabilities from their books at their book carrying amount. Any gap, capital reserve. After seeing any PC, maybe there may not be there for transferor entity. Transferee entity definitely will have to pay PC. That PC, whatever payable is it that you record, assets and liabilities incorporation should happen only at carrying amount of the transfer. Whatever amounts you removed there, other amount you recognize assets and liabilities there. Here also entry may not tally, then the difference will be transferred to capital reserve. Do not use fair values. Do not create goodwill. So this is that. Then what we actually learned in C entries, just to remind you, because in one or two sums this application is also there. When amalgamation is in the nature of merger, you will apply pooling of interest method. When you apply pooling of interest method, what you will do is, suppose this B Limited balance sheet is there. They are having assets of 200. They are having liabilities of 50. They are having equity share capital of 100. They are having general reserve of 30. Some P&L accountless surplus of 20. This is the balance sheet of B Limited. Imagine the PC what you are paying is 120 in the form of shares, merger no only shares. So what normally we do is take the share capital of B Limited, which is 100, compare that with PC. We are paying same PC or no, we are paying more. How much more? 20. This is a kind of a loss for us, which is extra PC you are paying. But since amalgamation is in the nature of merger and you are applying pooling of interest method, each and every reserve of selling company can be incorporated as a reserve of purchasing company. So you will have incoming reserves now. So you have general reserve and you have P&L. How much balances are there? 30 and 20. But if processor you are suffering a loss of 20, i.e. loss, adjust it here. So you can incorporate 10 and 20. So to write the entry, it will look like this. Assets account debit 200, to liability 50, to business purchase 120, the PC part, to general reserve 10, to P&L account. You can see the entry perfectly agrees. You will not write anything as balancing figure here. If it is amalgamation in the nature of purchase, you will call it as a balancing figure. If amalgamation is in the nature of merger, you will not use balancing figure. Rather, you will do this entire approach. Okay, sir. See, sir, when this is the pooling of interest method, what we have learnt, then why did you discuss this? You observe, sir, pretty much it's the same thing. All assets liabilities are incorporated only at the book value. But why I have discussed this method is, we have two questions in the study material which are demerger with common control. That means this laptop mobile division kind of sum. In this sum, what happens is, technically B is taking over a division, but B is not taking over entire A Limited. No. If B was taking over entire A Limited as a common control transaction, I would have adjusted all the reserves of A Limited into B Limited. But in the case of one division, the reserves of A Limited cannot be split division wise. So you will not be having data of reserves, how much reserves belongs to mobile division, how much reserves belong to laptop division. This kind of split you may not have. So IC study material answer has been given like this. You incorporate all the assets, all the liabilities at book values, gap you adjust it into capital reserve. That's the treatment they have done. So I've followed that. But there is one more case, one more scenario where this kind of thing is there, where the selling company has some reserves and all, but there is a common shareholder in A Limited, B Limited also, they both are merging now. In this, what is happening? The same fellow is controlling the businesses before and after the arrangement. So every reserve of B Limited can be incorporated after adjusting this. So basically all the reserves in their own identity, it will be taken over in pooling of interest method. But since that is not possible in a demerger case, because you are not taking over entire A Limited, we are only talking about a division. So A Limited reserves being taken over by B Limited is not technically possible here. That's why study material they have adjusted it against capital reserve. So this is that. Then we have reverse acquisition. Reverse acquisition we will directly discuss with the help of an numerical example in your study material. One or two questions are there on reverse acquisition. Full questions we will do. Meanwhile, we will also see one or two questions on these concepts of business combination, common control also. We'll continue with the questions, sir.